Hello, I'm Angelina Wu, Chief Executive Officer of InvestmentMarkets. Tonight, I warmly welcome you to our July Investor Webinar, an enlightening 3-day event filled with valuable insights and knowledge. We are witnessing a remarkable shift in the global economy, leaving behind the dreaded stagflation and embracing a period of modest yet encouraging growth in 2023 and 2024. The news we received is far more positive than we initially feared, thanks to China reopening its economy after the challenges posed by COVID, as well as the resilience of the US and Eurozone economies in the face of high energy prices. Consumer prices in Australia eased slightly in the March quarter, suggesting that inflation has reached its highest point. However, inflation still remains high overall, and prices for services continue to rise, which could be more long-lasting than initially anticipated. In the next 3 days, our team is thrilled to present you with 30 industry leaders from the wealth management community who are passionate about sharing their expertise. For those who attended our previous webinar in March this year, you'll find a similar structure, but with some exciting changes. This time, we have divided the webinar into 3 sections spread across 3 days. Each speaker will provide valuable insights to their respective topics, followed by a brief Q&A session with me. We have categorized each day's sessions into different perspectives. On the first day, we'll focus on Australian perspectives, while the second day will feature alternative ESG perspectives and global perspectives. And finally, on the last day, we'll delve into property and income perspectives and ETF and commodities perspectives. This new edition of the ETF and commodities category reflects our commitment to providing you with the most comprehensive range of Australian investment opportunities and educational resources. I'm especially thrilled to announce that on the second day, we have a guest speaker, Mr. David Bassanese, the chief economist of Beta Shares, who will provide us with an economic update followed with a Q&A session with me. Also, 10 lucky individuals will receive a hard copy of his highly regarded book, considered to be Australia's most comprehensive ETF guide. Tonight, during the Australian Perspectives session, you'll hear from esteemed speakers such as Roger Montgomery from Montgomery, who will explain why now is the best time to invest in small caps. Jim Bailey from Tribeca Investment Partners will provide us with an Australian share market outlook. Jason Ho from Hamilton 12 will showcase a strategy to achieve an after-tax dividend yield that surpasses the broader Australian share market while maintaining a similar level of risk and lower costs. Additionally, Jesse Moors and Nick Quinn from Spatium will demonstrate their expertise in exploiting short-term price dislocations. Now, I won't delve into the agenda of the second and third days here, but I strongly encourage you to visit the event page on www.investmentmarkets.com.au to discuss the perspectives that resonate with your interest and plan your attendance. The same link you use to watch this live stream will provide you access to the entire 3-day live stream webinar. Following the event, you'll receive emails containing the names, topics, and contact details of each speaker, should you wish to connect with them for further questions and discussions. We firmly believe that investmentmarkets.com.au are embarking on a transformative journey. exploring new horizons and perspectives that will evolutionize the way we approach investments. Our purpose is to empower independently minded investors like you to achieve success in your financial ambitions. We hope this webinar, our other education resources, and our compendium of investment products will provide valuable assistance in realizing your financial goals. Once again, on behalf of my team, I extend my heartfelt gratitude for choosing Investment Markets as your trusted investment platform. Without further delay, let's welcome our first speaker tonight, Mr. Daniel Stein, Senior Investment Analyst from OC Funds Management. The OC Premium Small Companies Fund is a managed fund that invests in small to mid-cap Australian listed companies. The fund aims to outperform the S&P ASX Small Ordinaries Accumulation Index by 3 to 5% per annum over a rolling 5-year period after fees. Daniel is a Senior Investment Analyst responsible for financial modeling and researching small and micro-cap companies with a strong focus on identifying value creation opportunities. He previously worked at Katana Asset Management, Wilson HTM, and Azure Capital. Daniel's topic is micro-cap companies, invest in the mid-cap companies of the future. Welcome, Daniel.
Thanks, Angelina. Thanks for that great introduction. I know that you've got a great agenda full of really exciting and interesting fund managers that have a long track record that I follow. So it'd be great to actually listen to some of the fund managers you've got coming up presenting. My name's Dan Stein. As I mentioned, I'm part of OC Funds Management. And today I'd like to take you through a bit about OC, why invest in micro caps, and how we're positioned in this current environment. So just in terms of OC, we're a small and micro cap specialist fund manager based in Melbourne, Victoria. We look after two main strategies, being small and micro cap Aussie equities. We've got a team of 5 really experienced investment professionals. And it might not seem like it, but I've been investing in small and micro caps at OC for over 6 years. Often I get, questions, and some people feel surprised because, I've been in meetings with a CFO who asked me to get him a coffee and also pick up his dry cleaning because he thought he was the intern. But I've actually been investing in small micro caps alongside this team for over 6 years. And the guys we've got in the team are all very experienced, very stable, and have very deep relationships in the small and micro cap space, which is extremely important. Moving along, just to bring up that slide. Moving along, OC, our micro cap fund, invests in micro cap companies which have a market cap below 500 mil in market cap. And we're really focusing on companies that we can understand. And what that means is typically we won't invest in single mine, single commodity mining or energy stocks. We don't do early stage biotechs, and typically we avoid really early stage companies. We are style neutral, so we do invest in both growth and value companies. I know you've got some really good growth managers coming up, such as ECP. And yes, we really do like investing in good growth stories, but we do have a balance of also companies that have more conservative valuations that do pay a dividend and may trade on less than 15 times PE. So moving along, why small and micro caps? Look, this is a really interesting part of the market, and we're really passionate about finding these small micro cap companies that are earlier stage and that do have a longer period of time where they can compound earnings at 10 to 20% per annum. And so for us, this is really important in terms of generating that outperformance by finding these companies that do have the potential to keep growing strongly over a longer period of time. Often as well, you'll find when these companies are a bit early stage, you do find the company's founders are still actively involved in the day-to-day management. And what this means is that they have a bit of a more entrepreneurial kind of way of managing the company. And you also get a lot of founders and managers that do own equity. And this is really important as they own the same equity that we own. And we really think that alignment is a really big reason why you can generate better returns and growth in microcap companies. Furthermore, you'll find that as these companies are typically a little bit more illiquid, there's less coverage by brokers, and that means that you can find companies that have probably a better risk return in terms of a better valuation for their growth profile due to this less or lower research coverage. And you can see that this is true of companies that started off as microcaps, such as Afterpay, then became a small cap company, then became a large cap company. And at OC, because we've got both microcap and small cap, we can follow these companies that might go from pre-IPO to IPOing as a microcap and then graduating into a small cap and then a mid cap. And that is the appeal of having both a microcap and a small cap fund together. Moving on to the next slide. This is sort of culminated in a strong long-term track record of investing at OC Microcap. We've got a longer-term track record of strong performance. You'll note that this year we did beat our benchmark, which is the Emerging Companies Index. This is a slightly different index to our portfolio. As I mentioned, we don't really invest in single commodity stocks, but they do definitely feature in the Emerging Companies Index. And this was also pronounced in FY22, which was a tougher year for smaller micro-cap companies. And the reason is typically because when the market anticipates a tougher economic cycle, the market will rotate out of smaller micro-cap stocks, which are a little bit more illiquid and a little bit more exposed to macroeconomic conditions as they're less diversified and have a shorter, have been around for a shorter period of time. And as investors move back into small caps and larger, more liquid stocks, typically the smaller end underperforms. And you can see that in the next slide, slide 9. And this actually looks at data that's come out of the US, and this is really data from the Russell 200 small cap index. And you can see that the Russell underperforms going into a recession as the market rotates back to larger cap companies, which is illustrated by the S&P 500. So going into a recession, larger cap stocks will outperform smaller cap stocks. And then when the recession actually starts, smaller cap stocks start to outperform. And this has been true for the last, I think it was 8 recessions that have been documented, 6 recessions in this amount of data that should come out of William Blair. So this data doesn't actually exist for Australia because there hasn't been that many recessions in the previous 20 years. So small caps should outperform large cap stocks typically as we enter a recession, and this is really the opportunity for smaller micro cap stocks. And if it was true of small cap stocks in the US, it was definitely pronounced in micro caps. As we found in FY22, liquidity definitely tightened up in the micro cap end as the market rotated out of micro caps and back into the safer haven of more liquid large caps. And so how are we positioned in this environment? In a slowing economic environment, we're definitely focusing on companies that have high quality, resilient earnings streams that can grow in despite of a slower environment. And we're also focused on companies that have pricing power because as costs are inflating through wages and rents, we do see that margins can potentially get squeezed. So companies that are able to increase prices with their customers will definitely be able to generate better earnings and more resilient earnings growth. And we think these companies which have more resilient earnings growth will be scarce in that environment and therefore will attract more premium valuations. So moving into our approach, as I mentioned, those are the sort of companies we're focused on that do have, resilient earnings, but also reasonable valuations. And in terms of the stocks we've added Aussie Broadband, Chrysos, SmartPay into our micro cap portfolio. I can talk to those in a little bit more detail, but ultimately we're really trying to find companies that have high degrees of earnings certainty that can keep growing. So Aspen Group is an example of that. This is a business which is half a holiday park and half a residential rental business. Rents are currently going up 10% in their portfolio, so you can kind of see that pricing power is coming through and buttressing earnings. We're also increasing our exposure to companies with pricing power. As I mentioned, some examples are Monash IVF, which is a fertility business, and they're definitely increasing prices. and Probiotech, which is a manufacturer that is also able to get price rises through their large pharma customer base. So we do have a reasonable amount of cash on hand in case the market sells off, and we can buy some of these attractive stocks at a better valuation. And we're also very focused on balance sheet currently. So this is a key example of some of the stocks we've added to the portfolio. I've talked to them broadly, but just given the time constraints, we can talk to them in the Q&A perhaps. But overall, that's OC Microcap and how we're really focused on the space. If you have any other questions, please feel free to contact client services at Copia or drop us a line. More than happy to take any questions. Thank you.
Thank you, Daniel. It's a great presentation. We got some questions for you. Can you give us some examples of your fund's current small or micro cap stocks exposure?
Yeah, it's great question. We are definitely focused on, as I mentioned, still finding companies that can grow despite a tougher economic environment. And one key example might be SmartPay. So SmartPay is a company which provides card terminal to small businesses. And you might have come across SmartPay as you've gone to buy a coffee at your local cafe. SmartPay has actually been really successful in the last year at growing customers. So they've grown their customer base by over 60% in the last 12 months. And when you find companies that are growing this quickly, it's often the most important question is to work out why. And so when I went to the local coffee shop in the food court down the road, I asked the merchant, why do you have a SmartPay terminal? Why do you like it? And the answer was that this merchant at the coffee shop used to pay CBA $2,000 a month to rent a terminal, but today pays nothing using a SmartPay terminal and didn't require any capital at all. $2,000 a month is a lot of money, particularly for a small business. You know, it can be $24,000 a year. That's a lot of money which can go into, generating additional growth through investing in your business or, paying off your mortgage. And the reason is because Smart Charge is sort of the business model which SmartPay is using, and they're effectively increasing the surcharge that goes through to the customers of the cafe, and that is paying for the terminal rental fees, merchant service fee, and effectively SmartPay's revenue. So given this zero cost FPOS solution makes a lot of sense, can save these SMEs a lot of money, they are winning customers very quickly away from the big four banks in Australia. Another example might be Viva Leisure, which is a less sort of, a company that trades on a lower multiple than SmartPay, is still growing. And this is a gym operator which operates both a corporate-owned network plus a franchisee-owned network. And Viva Leisure has found that they're still getting gym memberships, new people joining gyms. I went to the gym today at 6 a.m. It was still really busy. And customers are still valuing their health, even though, the gym might cost $16 a week. We're finding that in an environment where discretionary retailers have noticed a large drop-off in sales through April, May, June, Viva Leisure is still actively growing their gym members. So this is a company which is still growing, but is trading on 9 times PE and is sort of more of a value at the value end of our portfolio. So there are two examples of companies that we still like and we still are supporting in our microcap fund.
Yeah, got a few questions for you, but in the interest of time, I might just squeeze in one more question.
Sure.
What is the hardest part of researching and valuing a small company that may have very limited business track record and does not have a lot of publicly available broker research about it?
Yeah, I think liquidity and actually, getting access to companies' management teams is a really key element that is really fundamental to investing in microcap funds and microcap sort of companies. An example might be Probiotech. So this is a contract manufacturer of over-the-counter pharmaceuticals. So they manufacture Benadryl and other cold and flu medicines for large pharma companies such as Johnson & Johnson. And it's not a very liquid company without a lot of broker coverage. So to actually understand these businesses, which is fundamental to investing in microcap businesses, you do have to reach out and go and see these companies face to face and build relationships the old-fashioned way, which is really going out and seeing companies. So we have a visitation program of going and seeing, over 1,000 companies, over 1,000 meetings per annum. So that's really important in investing in microcap companies.
Makes sense. Well, old school can be good school, right? Well, thank you, Daniel. Great to see you, and all the best.
Fantastic. Thanks, Angelina. Thanks for your time.
Now, since inception, the Katana Australian Equity Fund has outperformed the All Ordinaries Accumulation Index by more than 2.9% per annum net of all fees. It has outperformed the market over every time frame, including 1, 3, 5, and 10 years. And since inception 16 years ago. As of April 2023, it was ranked in the top 2% of funds over 3 years, top 3% over 5 years, and top 4% over 10 years, according to Morningstar. Its portfolio manager, Mr. Romano Sala Tenna, is with us today. Romano is no stranger to the investor community, as he appears regularly in the Australian Financial Review, the Sydney Morning Herald, Livewire, First Links, as well as a host of smaller publications. He also appears on television and radio and has been a keynote speaker at conferences both internationally and domestically. Romano's topic is an introduction to the Katana Australian Equity Fund, Australia's most consistent fund over 1, 3, 5, 7, and 10 years. Welcome, Romano.
Thanks, Angela, and nice to be here. I'll get straight into it. We only got a short time. I'd like to cover 3 things today. Firstly, volatility, time, and compounding, because that explains how Katana thinks about investing. I'll give you a brief introduction to who Katana is, and then finally look at our performance update. So let's get right into it. Volatility, timing, and compound. If you could imagine, we've got 147 years of data now, which gives us a lot of data points to look at how markets operate. Over that time frame, 147 years, exactly 30 years the markets dropped, 117 years the markets increased. So that means 4 out of 5 years the market will go up, 1 out of 5 years the market will go down. And why is that important? Because you will come in at some stage and think, my goodness, why do I invest in Katana? My goodness, why do I invest in the stock market? We want to make sure that people understand that volatility is a part of investing in the markets, the price you pay for a seat at the table. And that if you are forearmed with that information, you'll do the right thing at the wrong time, as opposed to doing the wrong thing at the wrong time. If you look at that 147 years of data, when the market does drop, it drops by an average of 10.1%. When it goes up by 16.1%. Combining those years, we get this magical number there, 10.8%. So over 147 years, the ASX has gone up by 10.8% capital growth and dividends on average. So really important to understand the context in which we're investing. We've only got a very short time frame today, so we are going to just take out two of over 100 slides that we have talking about volatility, timing, and compounding. But imagine this. Imagine that you invested in the index for 5 years. So you're no smarter, no dumber, you just put your money into the ASX accumulation index. You turned your screen off and you came back in 5 years' time. On average, what do you see? Well, over 147 years, there's 143 rolling 5-year periods. The average return would have been 65%. So compounding at 10.8% per annum would have started to see the first effects of compounding cut in. You would have averaged 65% return over the 5 years. And there still would have been 7 negative 5-year rolling time frames. So 7 periods where you may have been unfortunate enough to have invested and had a negative return over that time frame. If you did the same thing for 7 years, invested in the index, nothing smarter, nothing dumber, shut your screen off, came back in 7 years' time, what does it look like? You start to see the effects of compounding, 100.6% return, and there still would have been 2 periods where you may have been unlucky enough to have a negative return, 73, 74, or years around 2011. Do go 1 more year, and even though you've only invested 1 more year at 10.8%, you're starting to see compounding really kick in. That extra year gives you an extra 20% return. And there would have been 0 occasions over the last 147 years where you would have had a negative return over 8 years or more. So that really, at a very quick overview, gives you an understanding of how Katana thinks in terms of compounding, to overcome volatility and compounding to maximise the impact of time in the market. Okay, so who's Katana? Well, Katana is a fund set up in Perth in 2003. We issued our first fund in January 2006. There's 4 investment professionals that manage the money. Brad and myself, co-founders. Giuliano joined us in 2010, and Hendricks and Newby there back in, is in his 4th year now working with us. Now, interestingly enough, what we see there is that Giuliano, Brad and myself are the 3 portfolio managers, and there's a high level of depth and a high level of stability. Most portfolios will be managed by 1 or 2 portfolio managers. We have 3, and the 3 portfolio managers are in our 13th year of working together. So a high degree of stability, high degree of tenure. Every investment that we invest in must cover off on 11 key criteria as listed here. And these key criteria in approximate order of how we see their importance. So first and foremost, we look for management, try to understand organisational culture, management, performance. We look at the business model, what sustainable competitive advantages it has. We look at value and growth, macro, sentiment. We look at balance sheet, earnings. You know, if you said to me, what's our big learning over the last 15 years? It's about quality of earnings. Why do you pay 25 times for one company and you don't pay 8 times for another company? It comes back to the degree of transparency, consistency, what factors inside or outside of management control, you know, whether there's a high degree of a large number of small customers or a small number of large customers. All of these things impact your quality of earnings. Look at cash flow, especially operational cash flow and free cash flow. Warren Buffett's favourite measure, return on equity. So look at return on equity, return on invested capital, return on assets. Understand the power that you're getting from adding an extra dollar to the business. And then look at liquidity in terms of size. You know, we are not afraid to invest in smaller companies, but we don't do it often because a smaller company has less liquidity, less diversification, probably less corporate governance, less research coverage, etc. So we'll invest in larger companies generally, and we'll happily take a 10% trade in Westpac Bank every month of the year if we've got a line of sight on a trade. But we won't invest in a small company unless we've got line of sight on a 50 to 70% return. Then in 2022, we added ESG. We've always been really big on ESG, but more as GSE, looking at corporate governance and the social license to act in a jurisdiction. Now, we've added ESG because it's now tangibly impacting the valuations that are applied to shares. As a simple example, where we might have previously bought Woodside on a P of, say, 13 to 14 times for a trade through to 2021 times with imminent triggers, now we're looking to buy Woodside on 8 to 9 times with a trade through to probably exiting around the 13 to 14 times. So ESG is tangibly discounting the valuations that investors are prepared to pay for certain sectors of the market. And then finally, we have up to 155 additional data checks that we can apply depending on how much confidence and familiarity we have with a company. Over the last 30 years, we've learned a lot of things about how you can lose money. And so we've built that into a very extensive database of checks that we have to apply if we have some element we're not as confident about. And there might be things as simple as, has management sold stock in the last 3 months? What are the KPIs around remuneration? Has a company done a capital raise in the last 6 months? These things in and of themselves don't preclude us from investing in the company, but they are things that we need to look at and sign off on to make sure that we understand why they have transpired. If you look at our typical portfolio, here's a recent portfolio. This is our top 10. You know, most of what we do is in the ASX 20 or ASX 50, and yet our returns are substantially above that because of our timing of those stocks. We've been above 5% on 3 stocks in 17 years. We're very risk averse and very diverse. We average 55 to 65 stocks through the cycle. On average, most positions are 1 to 2%. 3% is rare, and above 5% has literally only happened on 3 stocks in 17 years. Mineral Resources, Commonwealth Serum Laboratories, and Commonwealth Bank. We average 15 to 35% cash to the cycle. We're often criticised for that. But my comment is, if we can get the returns that we've achieved with a diverse portfolio and a large cash weighting, then that's a better risk-adjusted outcome. Okay, so let's have a quick look at our performance update there. One of the things that gives us confidence at Katana is that we haven't just outperformed over the last 12 months, or we outperformed 5 years ago and haven't outperformed since then. Katana has outperformed over every time frame since inception 17 years ago. And it gives us, as I said, that confidence that there's something that's replicable and sustainable in terms of how we are delivering our performance. And you can see here, we've just taken some samples over 1, 3, 5, and since inception to give you an idea of how we've outperformed. To make that a little bit more meaningful, if we have a look at our since inception numbers, if you can imagine this is our long-term returns, that second line from the bottom, 192% return, that is the STW.AXWs. That's the biggest and most widely used ETF in the marketplace at the moment. And we often get asked, well, why don't I just put my money into an ETF? Well, I think this chart answers that question. If you invested in the STW.AXW ETF, since inception, you have 192% return. Over the same time frame, you'd have a 402% return investing Katana net of all fees. So quite a substantial increase as we compound, an extra 2.7 to 2.9% per annum over the long term. We start to see the impact that has. Now, there's different ways you can blow a fund up, and we've been saying for 17 years that we're a lower risk fund. We've got the data now to prove that. But why do we say we're a lower risk fund? Well, first and foremost is no gearing and no derivatives. They're the two big ways that you can potentially blow up a fund. We have a high diverse portfolio, as I mentioned, 55 to 65 stocks. We have a high cash weighting, 15 to 35% through the cycle. High quality stocks, every stock must go through a defined process and check off on very clear criteria before it makes it into the portfolio. And the third way you can potentially blow up a portfolio is to have unlisted investments, as you saw during the GFC. Everything we invest in is ASX listed. There's no offshore exposure. There's no offshore currency or whatever else. It's all ASX listed investments. There's no short selling. Again, that can add a high level of risk to a portfolio. And finally, and this point's very, very important, there's the highest level of alignment. The management team own over 20% of the funds under management. So capital preservation is at the forefront of everything we do. We are not going to invest this money to get a performance fee or to try and get a spectacular return. What we're about doing is ensuring we preserve our capital and then get the best risk-adjusted return we can, given that our capital is going to be here in the next 12 months. I said we've got the data now to start to support this. Over the medium term, when the market drops, we outperform the index 83.3% of the time, and by an average of 1.34% per annum. So if you suspect we're heading into a more volatile period, then downside protection becomes as important as upside performance. And you can see here that we've got a very high level of downside protection, outperforming 83.3% of the time in down markets. And I think that's especially important for advisors. It's hard to sit in front of a client and say, hey, we've lost, the market's down 10%, but it's even harder when you say the market's down 10%, but your portfolio is now down 12%. Just pulling some data off Morningstar. This is the most recent data we've got. The June numbers aren't through Morningstar as yet. 31st of May, you can see here that over 3, 5, and 10 years, we've substantially outperformed our peer groups. You can also see here that if you look on the right-hand bars there, you'll see that and the data's just slightly changed, but over 3 years, we're in the top 4% of managers, over 5 years, the top 3% of managers, and over 10 years, the top 3% of managers as per the Morningstar database. So we're arguably Australia's most consistent manager, and you've probably never heard of us. Morningstar put out quantitative ratings over 3, 5, 10 years, and overall, they're the only 4 periods they do that. We've got a 5-star rating over all 4 timeframes. We have a high investment grade rating or superior rating with SQM. And in 2022, we received one of 10 Star Manager Awards given out of a starting field of around about 10,000 funds. So as you can see, we're starting to get some recognition for our consistent performance, and we hope that they'll continue over the coming months and years. So Angela, that's a very brief overview. Did you have any questions you'd like to put to us?
Thanks, Romano. Yes, I do have a question for you. So I'm aware that a lot of funds have been successful, but they're over different periods. Your fund is a bit different. Your fund has been successful over all time frames for more than 17 years. That's a long-term record. So what's your secret? What do you contribute this consistency to?
It's a good question. I think it's a couple of things. Firstly, I think we made a lot of mistakes before we started in funds management. So we're professional advisors and investors for nearly 15 years prior to that, and we learned a lot of the things where people go wrong, and we've had the opportunity to see a lot of professional managers over time firsthand as well, and learn from some of the very best there. I think the second thing, though, is that we've also tried to remove any artificial constraints. And one simple example is, you might see yourself as a value investor or a growth investor. Well, thinking of the Australian landscape, you don't have the luxury to be a value investor or to be a growth investor. Growth outperformed for 10 years, values outperformed for the last 2 years. We've outperformed all the way through. So I think you've got to try and remove artificial constraints around style, around market capitalisation, around sector, around how you think about investing, not be restricted to looking at the index. Obviously, we need to mark our performance to the index so people can see how we've performed, but not to restrain or restrict your thinking to say, hey, the banking sector makes up 25% of the market, therefore the default position is 25%. Our thinking is the banking sector makes up 25% of the market. Our default position is 0% unless we can come up with a reason why we think the banking sector will outperform, or it'll have genuine alpha above and beyond the market.
Thank you, Romano. It's great to see you today, and thank you for the presentation and the Q&A. Take care. Now, our third speaker of today's Australian Perspectives is from Allan Gray. The Allan Gray Australia Equity Fund seeks to provide long-term returns that are higher than the benchmark, the S&P and ASX 300 Accumulation Index. Joining us is their Business Development Manager, Mr. Chris Hestelow. Welcome, Chris. Now, Chris's title for today is What is Contrarian Investing?
Thanks so much, Angelina. And thank you, viewers. I'm very grateful for the opportunity to speak a little bit today about contrarian investing. Before I get underway, I should mention that anything I say today is, of course, general in nature, doesn't take into account the viewer's personal needs, objectives, or circumstances. If you are in need of personal financial advice, I would encourage you to seek the assistance of a qualified financial planner. As humans, we've really evolved to seek the wisdom of the crowd. For all of human evolution, it was quite dangerous to be the odd one out or the one that was outside the tribe. And it's for that reason that we've developed kind of an intrinsic need to copy what those are doing around us. Even today, we look at TripAdvisor and Amazon reviews and Google reviews because we want to imitate the best travel habits, the best eating habits, and the best shopping habits. Usually this is a pretty good strategy. If we think about engineering, if we were building a bridge and 99 out of 100 engineers said that we need a certain amount of concrete and a certain amount of reinforcement, and there was one engineer who said, no, don't worry, you need much less concrete, much less reinforcement. Here's my design, follow my design. You'd be well advised to go with the 99 and not listen to the contrarian in that scenario. Usually, seeking the wisdom of the crowd is quite a good strategy. But in investing, things are quite different. And going with what everyone else is doing and copying others can sometimes be quite dangerous and lead to adverse investing impacts. Copying what everyone does around us in investment markets often leads us to buy those shares that have a great story around them, that everyone says are great investment opportunities. Usually they've done very well in the recent past and they're comfortable to invest in. What often happens in those scenarios is that very quickly those stocks become overpriced and can trade at prices above their intrinsic value, driven by the optimism of the crowd. At its worst, it can lead to market bubbles, where prices become completely dislocated from their fundamental value, and the incremental investor that comes along and purchases the next share overpays and permanently impairs their capital when the bubble inevitably bursts. Those forces that can drive share prices up and up on widespread optimism work just as powerfully in reverse. And so those stocks that don't have such a rosy story, that have done poorly in the recent past, or that are uncomfortable to invest in, can often trade at discounts to intrinsic value due to an overreaction and people being overly pessimistic. Those are the companies that we seek to look at and invest in if the price makes sense. Companies can be out of favor for a multitude of reasons. They may have disappointed on earnings. The market may have lost faith in the management team, or they may be exposed to a commodity that's at cyclical lows. We look to buy those companies that are out of favor and that where there has been a reaction and a mispricing has occurred. We are long-term investors, so our average holding period is much, much longer than the average market participant on the ASX. And that seems to complement the contrarian way of doing things. Often it does take some time for the news cycle to move on, or for the rest of the market to come around, I guess, to our view and realize that there's been an overreaction to the downside. We are also fundamental investors, so we employ 9 analysts in Sydney from a very diverse range of backgrounds, including academia and consulting. And it's their job to do the hard work to formulate an independent view of the intrinsic value of a business, and that informs our buying and selling behavior. This is a bit of a stylized view of what we're trying to achieve and how we're trying to invest. You can see that assessment of intrinsic value in the grey that I mentioned. It's the analyst's job to calculate and form a view on. And you can see share prices generally oscillate a lot more than the actual value of a business. We look to buy at prices below the intrinsic value as mentioned, but one interesting thing to note is that black dot is not right at the bottom of the curve. We can never know where the bottom is. Usually the selling behavior is being driven by human emotions and human biases. And so it's for that reason that we usually take a bit of a position in a stock. If it continues to trade off and our assessment of true value hasn't changed or has increased, we'll build that position over time on subsequent weakness. The nice thing about being a price-focused investor is that you know exactly when to exit a stock, and that's when it reaches our assessment of intrinsic value. We don't try and ride the wave of optimism that can sometimes come after that point, as we believe it relies on, I guess, the greater fool buying the share off you. And so it's almost a function of the approach that we get in early and get out early. But that is the best way that we think we can manage money and deliver excess returns and alpha to our clients. There is some empirical evidence for a contrarian approach. So the Brandeis Institute some time ago conducted what they called a falling knives analysis. In this analysis, they defined a falling knife as a stock that had fallen 60% or more over a preceding 12-month period. And they then took those stocks and tracked how they did in the subsequent 3 years. In the US, including companies that went bankrupt, the knives delivered a return of 11.2% relative to the 4.6% of the S&P 500. And when they took that same methodology outside the US, the non-US knives delivered 10.8% relative to 5.3% for the MSCI index. It should be said, we don't just go out and buy companies that have fallen and because they've fallen, but that's usually what piques our interest and where the research process might begin. One of the reasons that contrarian investing works is that share price returns are not so much based on business outcomes as they are based upon business outcomes relative to market expectations. What I mean by that is, if a stock is priced for a great outcome and merely delivers a good or an average result, you can do quite poorly as an investor, and the share will often sell off. We see this very often. Often a company will come out, release its annual report, and they have record profits, record earnings. But on the day that it's released, the share price falls in value, which can be confusing to a lot of market participants. The reason that happens is because the market was expecting an even greater result. And that's really what we mean when we say a stock is priced for perfection. On the other side of the curve, if we look at point B, if everyone expects a dreadful outcome for a business, expects nothing of the business, and it goes on to deliver a poor or even better, an average result, to oversimplify things, you can do quite well as an investor and see share price appreciation. And so it's for that reason that we don't need a miraculous turnaround in the fortunes of these companies. We don't even necessarily need a catalyst. We just need the future to be a little bit brighter than the broader market is expecting. And that can become a lower hurdle when there is widespread pessimism and no one expects anything of the business. To be a contrarian investor, you do need to engage in a lot of second level or second order thinking. First order thinking would be using rules of thumb, or I guess what's called heuristics in behavioral finance. This share's done very, very well. Everyone else is buying it. I've got to have some in my portfolio. Or everyone's saying a recession's around the corner. I want to skew my portfolio heavily towards consumer staples, wherever it might be. What is missing in that conversation or that level of analysis is the price that you're paying for a security. Any company's value is the future earnings that it will generate for us as owners, discounted to today. And so as long as those earnings aren't zero, there is a price at which it makes sense to buy almost any company. And conversely, there's a price at which you would be overpaying to own any company or asset. As one of my favorite investors, Howard Marks, says, it's not just about buying good things, it's about buying things well. And so we need to engage in second level thinking. We need to think about what is the range of likely outcomes and what do we think will happen? What is the probability that we're right versus what does the consensus think? And how are our expectations different? In all likelihood, the person that is on the other side of the trade to us is just as motivated and just as smart, if not smarter. And so we need to think quite a lot about why they are willing to sell us a share at a price that we think is below its intrinsic value. And so I guess to summarize, enduring human bias does create opportunities for contrarian investors. It does require restraint, patience, and commitment in our convictions. Often we're buying the kind of companies that everyone tells us not to buy, and often they're proven right. And so you need the fortitude to deal with that. And it's not easy to be different, but the rewards can be great. And we think it's very, very worthwhile. Thanks very much.
Thanks, Chris. Thank you for your insight in contrarian investing. Now I have one question for you. So what funds do Allan Gray currently offer to the Australian investors? And do you consider the macroeconomic issues in your approach?
Great. Thanks, Angelina. So we currently offer 3 funds under the Allan Gray Australia brand to the Australian market. The first is a flagship equity strategy that's mandated to be fully invested in Australian companies, benchmarked against the ASX 300 index. The second is our balance fund, the Allan Gray Australia Balance Fund. It probably gives us the widest playing field in terms of the different type of assets we can purchase. It's benchmarked 60% growth assets, 40% defensive assets. And then within those sleeves, again, 60% domestic assets, Australian assets versus 40% global assets, with that global portion being managed by our sister company, Orbis, who has the exact same investment philosophy as us. And then the third fund we offer is our most conservative fund. It's called the Allan Gray Australia Stable Fund. It starts with 100% in cash, and that is term deposits less than 12-month maturity or Aussie government bonds less than 12-month maturity. And then when we think Australian shares are coming up as more attractive than cash on an absolute basis at the individual stock level, we can purchase positions in Australian companies up to a maximum of 50%. And so those are the 3 funds that we offer. In terms of that second component to your question, do we focus on the macro side or the macroeconomic side?
Yep.
We intentionally don't. We intentionally don't employ macroeconomists in our business. We do need to think about different states of the world and what it might look like for the businesses that we invest in. But when you take things out to the macroeconomic level, there's just such a huge multitude of variables that need to be taken into account. And it's very, very difficult to predict things with accuracy. And we've seen a lot of that recently. These central banks employ hundreds of economists and seem to be continually surprised by the next set of data that comes out. And so we don't focus at that level. We really are fundamental investors. The number of variables becomes smaller when you focus on the individual businesses and the earnings that we expect them to generate through the cycle. And so that's where we spend most of our time.
Thank you, Chris. Now the partner and portfolio manager of Hayborough Investment Partners, Mr. Ben Rundle, just joined the call. Some background of the Hayborough Opportunities Fund. It is a long-only, small-cap Australian equities fund investing in a portfolio of 20 to 40 high-quality small to mid-size ASX-listed equities. They believe companies exhibit a greater degree of pricing inefficiency over their larger counterparts, which can cause a large variation between the company's trading price and their assessment of a company's market value. Ben has 17 years of experience in financial markets, previously experienced working in Moors Asset Management, Moelis Company, Almanet, Macquarie Bank, and Taylor Collison. Ben's topic today is return on capital drives return on share price. Welcome, Ben, to the webinar.
Thank you. Thank you for having me. Thank you for Investment Markets. Hello, everyone. My name is Ben Rundle. So I'm the founder of Hayborough Investment Partners and the Hayborough Opportunities Fund. So I'll spend just a couple of minutes just quickly introducing myself and the fund and our process, and then I want to talk to you about two real-life examples of listed companies on the ASX operating in very similar sectors and look at quickly why one has done so much better than the other. So just starting with the team. So myself, obviously, I've been in the markets now for about 17 years. I started on the stockbroking side and moved on to funds management about 8.5, 9 years ago. My business partner, George Capozzi, has been in the markets for 20 years. He's been doing small caps for a significant period of that time. And our chairman, Jeff Ellison, is the founder of a company called Sealink. It's actually called Kelsian now, which is an ASX listed company. He'd us out of administration in 1994, I think it was, and now it's a $1.5 billion business. And he exhibits a lot of the traits that we look for in our management teams of the companies we invest in. Just a bit on our business. So we launched our fund in March 2021, so we're a little over 2 years old. Our performance in that time has been 27% versus the small cap index, which is down 4.5%. We launched with $10 million in FUM, in funds under management, and we're sitting at about 50 million now. George and I are the largest unit holders in the fund. At our 2-year anniversary, we were crowned the highest performing small mid-cap Australia, according to Morningstar, out of about 200 funds. So that was a pleasing result. And we're available on some of the more popular investment platforms for financial advisors to be able to allocate to our fund. There's essentially 5 pillars to our investment philosophy in the way that we invest. The first is our circle of competence. We don't know everything. There's 2,500 listed companies. We try to stick to a very small subset of those, of about 150 businesses that we know we've been following for a long time. We have financial models on, and we build a portfolio of 40 stocks out of that universe. We really like businesses where the management team own a significant stake in their business. We like founder-led. Most of our portfolio is run by founders of their business. And we really like companies with very strong cultures. We've found that over time, businesses that do have a strong culture have a very high and consistent track record of taking market share from incumbents, particularly the larger, more bureaucratic competitors that they operate against. And then on the numbers, we really like businesses which have a high return on capital, and I'll show you the example of why we like that as a core part of our investment process. And then finally, no business is so good that we'll own it at any valuation. Valuation's a really important factor of our process and how we try to limit mistakes in the portfolio. So the examples of the companies that I want to briefly take you through are 2 ASX listed companies. They're both of a similar size, roughly around $1.5 billion market cap, each of these businesses. The first is Lifestyle Communities. LIC is the code, and Ingenia Communities is one of their competitors, and the code there is INA. Now, the businesses aren't exactly alike. There are some subtle differences between the two, but really they both operate in the retirement living community sector. And it's worth noting that both have actually been fairly strong performers in that space, but we'll look at why one's been such a strong performer over the other. And the way that we've done that is by looking at a 5-year return analysis from 2017 to 2022. Now, the reason it's to 22 and not 23 is because the numbers haven't been announced yet for 23. We hope to get those next month. So it's a backwards looking view, but it gives us the benefit of hindsight to know what the numbers look like, what the starting valuations look like, and why one company's done better than the other. So if we start with probably the most common financial numbers you'll see in an analyst report, the growth in their profit, the growth in their net assets, and the starting valuation of what we've bought each company at in 2017. So that's the valuation of the business in 2017. So you can see over that time, Ingenia has grown their profits over 100%. Lifestyle Communities has been lower than that. Ingenia has grown their net assets at almost 200%, which outpaces Lifestyle Communities again. And there's a starting valuation of Ingenia of 0.9 times its book value versus Lifestyle Communities, which is almost 3 times its book value. So you're paying a lot less for Lifestyle, for Ingenia than you are for Lifestyle, and you're getting a lot more profit and asset growth. But if we look at the share price performance over that period, investors have made almost 3 times more money invested in Lifestyle Communities versus Ingenia. And we believe the reason is, so if we go back to that chart that I just showed you a minute ago of the growth in profit and the growth in assets, the bottom chart here is numbers that we prefer to look at in analysing a company. So the first is the growth in contributed capital, so how much capital it's taken for a company to actually grow, how much capital have gone into the business. The second is return on equity, and then the final piece is look at the incremental returns on capital. And you can see there that to get their results, Ingenia has grown their contributed capital by over 100%. So it's the equivalent of having a bank account with $100 in it and putting another $100 in it and having $200. You haven't really actually created value. Whereas Lifestyle Communities hasn't grown their contributed capital barely at all during that period. They've had a much higher return on equity, and you can see that the incremental returns on capital are so much higher. That's driven a vastly different outcome. Sorry, go back to the previous slide, of making literally 3 times more money invested in Lifestyle Communities despite being valued at 3 times higher at the starting process. So that's the framework that we like to use, if you like, from looking at a company. And from our historical track record and our experience in markets, it's the track record of companies being able to allocate their capital successfully that can drive share prices going forward. And we have actually found that historical views on capital allocation have been a pretty good indicator for future returns on their capital and therefore future returns on their share price. So just to summarise, the ideal company for us that we look at is founder-led. We really like companies that have high insider ownership. The management team treat their capital as if it's their own, because it is. We really dislike share issuance, so we dislike capital raisings on the market. So we like low issuance of shares, high returns on capital, companies going through an earnings growth phase. In small caps, we tend to find that a lot of businesses can be undiscovered by the wider market. And we have a very favourable bias towards a high cultural within the business as well. So that's a quick sort of 10-minute overview of Hayborough and what we do and how we do it. So I invite any questions that you might have.
Thanks, Ben. I recall you mentioned in your presentation that you like to analyse a company's culture. I get that, but how do you do that?
Yeah, that's where the hard work kicks in. So it's not as easy as just pulling up a spreadsheet and looking at the financial numbers. You actually have to go out and talk to people in business. So we spend a lot of our time speaking to not only the businesses themselves, but also their suppliers, their competitors, people who have operated in the industry can give us a fairly good flavour of how that company operates, as well as lower level management too. We obviously as fund managers get to speak to the management teams pretty regularly. But it's a lot harder to get access to lower level employees. There are easy ways to do it, of looking at things, websites like Glassdoor and that sort of thing, but we prefer to actually speak to people in the business and the industry to get a better view of what we're investing in.
And why do you have a bias towards founder-led management teams?
Well, founder-led management teams, given that they have so much money on the line invested in these companies, we're a big believer in incentives drive outcomes. So if you have a management team who owns 10 to 20% of the business, they're going to make decisions very differently from a company that has a management team that doesn't necessarily have a stake in their business. They might have options that they get granted through not having to put their hands in their own pockets, but that can drive very different outcomes. And incentives to us in particularly small growing businesses really drive strong outcomes in share price returns.
That makes sense. Thank you, Ben.
Lifestyle and communities, lifestyle communities and Ingenia, lifestyle communities is a founder-led business, whereas Ingenia is not, and you can see the differences in the returns between those two businesses.
Yeah, makes sense. Thank you, Ben. It's great to see you.
Excellent. Thanks for having me on.
I'd like to welcome our next speaker, Mr. Jinbei Liu, Portfolio Manager from Tribeca Investment Partners. The Tribeca Alpha Plus Fund is an Australian equity long-short strategy fund with the typical asset held in cash equivalent instruments, Australian listed shares, other equity-like securities, and exchange-traded derivatives. The fund aims to achieve positive returns in excess of the benchmark by taking both long positions and short positions in selected Australian shares. As the portfolio manager of the fund, Jinbei Liu has quadrupled the asset under management to $1.1 billion since taking over sole responsibility for managing the fund, making it one of the largest long-short equity funds in the Australian market. Jinbei is a prolific contributor to Australia's financial services sector. She writes a regular column for the AFR, making frequent appearances for key media outlets and as a speaker at industry events. She is a TEDx speaker, has been appointed as the co-fund manager for Hearts and Minds Investments, and volunteers for the Raise Foundation Board. Jinbei is going to give us an Australian share market outlook today. Welcome, Jinbei.
Thank you so much for having me, and thank you everyone for attending this. Look, I'm very honored to be speaking about Australian market because, Australian share market, in my view, is going through some important transition, and there's a few thematic that I think that as investor you should take advantage of, over the next 12 months. Now, I guess, many of you, if you know me, that I'm a very passionate investor. Share market is, fantastic asset class for investors looking for good return, particularly for active investors like myself. Australian share market has achieved a very good return in the last 12 months on the basis that now looking forward we have a more reasonable interest rate outlook. As last 12 months we have had quite an escalation in interest rates, and then inflation looks somewhat more reasonable, and if anything in the US market inflation started falling. So last 12 months, we have had a good market. Well, in fact, we actually have been very positive in the last 12 months, believing the share market was way too bearish, thinking we're got a crash coming. And it's not yet here. Our market delivered over 14% return for the financial year 2023. Now, looking forward next 12 months, we do think our share market is still very well positioned, on a few reasons. Well, first of all, our corporate earnings has proven to be incredibly resilient. Yes, our economy is slowing down, and in the next 6 months, we will see more downgrade. We will see corporate margin continue to start to contract. We'll see demand environment slowing down. Consumer particularly is going to slow down their spending. Now, in a way, it is a good thing because we want the interest rate to sort of capped out at where it is. If anything, perhaps one or another two increases, then sort of a significant jump in the next 12 months. So corporate earnings is slowing down. We've got on the 12-month horizon, we already have some of the early indication of improvement across in terms of immigration. We have a lot of people coming into Australia. it is the pent-up demand that is coming through in immigration, students, tourists. They're all coming back in a big way, slow, but coming back in a big way. If anything, in the next 12 months or next 2 years, we're expected, immigration in Australia is expected to get to something like 700,000 people coming to Australia in the next 2 years. And this compares to normally about 200,000 just before COVID. So a huge influx of people and coming into our economy. They will look for a place to stay. They will need to spend. They will look for education and consumer services. So that is quite a strong underpinning for the Australian market that is very unique for our markets. In fact, I think there is the IMF prediction for Australia sort of population growth placed at the highest in the next 2 decades compared to many other markets, even the emerging markets. So that's very positive for Australia. So we have a very strong tailwind of immigration. We've got student coming in. We have services that's continue to do very well. Also, as Australia, we've got good leverage into a reopening China. Clearly, Chinese market has been incredibly tough, and over the last few years because of their COVID-related impact, the hard lockdown, the the tough housing market has really impacted that economy. Now, so far this year, things are improving. Government is giving a lot of stimulus, and consumer finally can move around and find jobs and start consuming in services and travel. Now, this is still very early stage of a China recovery, but we are seeing good indication the last 6 better, and then there are more and more government stimulus targeting towards those sectors, and we do expect that to benefit Australia, not just the mining sector, but also services, travel, consumer, many other space. So so that's a very positive for Australia. So fundamentally, Australian economy is actually holding up a lot better than expected. There will be downgrade, but that is really helped the market to have a more realistic expectations. We always say that for share market to move higher, you need 2 things. One is you need the valuation valuation certainty, and 2, you need the earning certainty. Now, valuation certainty, we have received that in the last 6 months. This is when the interest rate increases or massive interest rate increases was really impacting the people's confidence in that valuation, and now we would say the worst is past us. So perhaps we still have another couple, but we're very close to the end of the interest rate increases. So that has seen the valuation sort of stabilizing, hence why you saw a bit of a rally across the tech companies. So we got that certainty. Now, earnings stability is the one that we're looking for in the next 6 months. We think this upcoming reporting season, corporates will downgrade earnings more. There will be more downgrade for 2024, and that is all going to be very healthy for the share market to be able to definitively move higher in the second half of this year. So Australian market is looking very strong with those tailwinds help us to offset the consumer weaknesses. I know it's very easy to become bearish of the Australian economy because all these headlines you read about the consumer gearing, the fixed mortgage cliff and all that. Now, the good thing is that so far things are holding up okay, and and then in 6 months, I do think we will be bottoming and we'll be heading higher. And what does that all mean for the share market? Remember, share market always forward looking. I started this conversation by saying that I love share market because it creates that opportunity for you to generate double-digit return within 12 months, whereas other asset classes it normally is very difficult unless you take on significant amount of risk. For the share market, they want to look forward. Investors always look forward 12 months. So right now, I would say we're at the tail end of really repricing some of the earnings downgrade. So that means we're getting very close to the bottom of some of those very cheap sectors. So, and we do expect them to do quite well in the next 12 months. And this reporting season could be the catalyst and opportunity for investors to really position in some of those high quality cyclical sectors that that's buying something that you always want to buy and much cheaper. So don't be set back by share price volatility. That's just part and parcel of generating quite a significant return in the following periods. Perhaps confusing everyone, we're very positive of the Australian market. We think it will do well. There will be a bit of a volatility as we downgrade earnings in the next 3 to 6 months, but we do think that by year end we should look at pretty good return for the Australian market. Now, I think, so this is kind of my overall outlook. If we are comparing the Australian market to the others, we do think in the next 12 months, there will be a bit of a change in terms of sector rotation. So last 6 months or last 12 months, at least tail end of last 12 months, we started seeing quite a significant outperformance by the NASDAQ or our tech sector, for example. Now, next 6 months or next 12 months, we're very likely to see that rotation into some of the cheaper sector I talked to, that the sector's earnings are likely to be downgraded because they are at the forefront of slowing economic activity, and then their earnings are very likely to rebound in the second half of the year. So then we do think that tech will continue to do well, but I do think that some investors will start doing a bit of profit taking and heading into these other sectors that sort of be under pressure. We continue to think the key theme of the China reopening is going to be important return driver. It's going to drive our commodities as expect, and also on the side there are many companies are leveraged to the China reopening, a lower risk leverage actually in a way. So sometimes for investors, much easier to invest in Australia that gain exposure to China than directly invest in China, because the volatility is much higher and you've got to move up the risk spectrum. So things like Treasury Wine, things like A2 gives you really good exposure to the China reopening, China consumer and China tourism, but without all that the risk that come with investing in a very high risk geographical space. So so in terms of share market, we're seeing plenty of opportunities. Investors got to stay patient, find the opportunity, and then don't be afraid, and then take advantage of the current market volatility, if you like, and your opportunity is really in the next few months when consensus earnings or analyst earnings gets downgraded. So that's kind of my outlook for the Australian markets. Let me know if you have any questions.
Thanks, Jinbei. We do have a few questions for you. You quadrupled the Alpha Plus Fund to $1.1 billion. So how did you take advantage of the market volatility that some people are scared of?
Yeah, absolutely. So, well, look, we just continue to find without being influenced by the market sentiment. So without being fearful when the market is falling or without being greedy when the market is rising, we are able to find opportunities in every sector. One of the philosophy I always believe in is that I want to find opportunity in every sector rather than just buying what's hot or selling what's not hot. I want to be able to be a little bit early, be a little bit contrarian, to generate my return. At the same time, on the portfolio level, manage it to a stable level. So by saying that is that obviously it's a little bit easier for me because I have a long short. I'm a long short fund, so I can manage my risk by shorting companies in the similar sector. So I can long the high quality and short the low quality, and then when the market falls, net the high quality company will always have investor support compared to the lower quality company. So that's how we play on every market cycle. We don't have to wait because we don't run out of cash. I don't have to sell the things I like to buy something. I can short more of the things I don't like to jump in at any opportunity whenever they present, and I don't need to worry about when is the next catalyst, when is anyone else going to recognize the opportunity, because I can afford to wait. I know the risk adjusted basis on the 12 month I'm going to generate significant return with low risk. I will take it any day. So that's kind of what it is. We're agile. We run like a business, right? So you see opportunity, you jump at it. And then you manage your whole, make sure the portfolio is stable, have enough defensive, and then respond to changing market dynamic. We never get wedded towards any stock or anything. It's mainly because we need to change when the information change, and you need to every time when there's new news flow and announcement, we need to reassess our position at any point in time. And a lot of time it actually creates opportunity, whether to buy more or do other things. So yeah, so that's the thing.
And you have a long short fund. So how does the ability to short stock help in this current market environment?
Yeah, absolutely. So, the market is very directional, right? So last 6 months, everyone wants to buy tech. Everyone wants to buy defensive, like Coles and Woolworths, sort of defensive, or Telstra. But for us, we hold some of those companies. But the ability to short is that I don't run out of cash. I can buy any company in the same sector and short something else in the same sector without increasing my risk level. So for example, for a long only manager, if you want to buy for example, what's not hot. If you want to buy a resource company, for example, then you have to sell, whether you sell whether it's your tech or elsewhere, or other things. To buy resource company increases your risk company exposure. So if China data is reading a little bit weak, your resource exposure is going to lower your return. At some point that return will come through, but just increase the volatility of your portfolio. And if that resource company keeps falling in terms of share price, you can't keep buying more because your portfolio has become very skewed. So for me, if I want to buy a resource company, or for example, at the moment, I see the biggest opportunity is actually in the healthcare space. I want to buy more healthcare, I can short another healthcare company. Or in fact, I can short something else with very similar characteristic, whether it's growth, whether it's all of that. Now, healthcare company represent phenomenal opportunity in the Australian market because they're structural leader. They will generate some of the best growth in the market. And you know what, which is very unusual, once in a decade opportunity or decade sort of impact, which is really healthcare company all has some sort of downgrade, which is very unusual. The reason being that they are very service oriented businesses. Nurses are hard to find, and some of the pandemic remnants of the pandemic impact is still lingering around, is impacting some of the earnings. But look, still, with all that aside, we actually think this sector represents significant amount of opportunity. We'll be buying more of that sector by shorting something else with very similar sort of characteristics and growth.
That makes sense. Thank you, Jean Bei. It's great to see you tonight. Take care.
Thank you so much for having me.
You're watching the first night of the Investment Markets Investor Seminar. Coming next, we have Mr. Jason Ho, Chief Investment Officer from Hamilton 12. The Hamilton 12 Australian Shares Income Fund aims to generate long-term after-tax returns, including an annual gross dividend yield in excess of the benchmark. The fund uses systematic evidence-based approach that allocates the portfolio towards securities offering high franked dividend yield, diversifying across industry sectors. The fund's benchmark is the S&P ASX 200 franking credit adjusted daily total return index. Jason has been widely recognized for his work on imputation credits. His work on valuation has been relied upon by companies listed on the ASX and by Australian state and federal government agencies. Prior to co-founding the company Hamilton 12, Jason was a director of the consulting firm Cardinal Economics and Finance, senior lecturer in finance at the University of Queensland, University of Michigan, and a board member of the CFA Society, Detroit. Welcome, Jason.
Thank you for having me. So in this short presentation, I want to talk about the performance of Australian high yield portfolios. At Hamilton 12, we have a particular high yield portfolio, which is invested in Australian shares paying high franked dividends. But this presentation is about a more general approach to portfolio formation. There's roughly $3.6 billion in ASX-listed high-yield exchange-traded funds, and S&P reports that they have been growing at 21% per year for the past 10 years. So clearly there's an appetite amongst Australian investors for yield. We know that's valuable for Australian residents amongst companies paying franked dividends, because even if they just hold the ASX 200, they receive roughly a 1 to 1.5% boost on an after-tax basis from the benefit of those credits. But what about the yield premium more generally? Across countries and over time, researchers have documented that there is a long-term yield premium in terms of total pre-tax returns from holding high-yield investments. But there is disagreement amongst researchers and portfolio managers as to why that long-term yield premium exists. Some researchers say, well, it's just risk. High-yield stocks are just riskier investments. But other people say no. There's market frictions in place, which means that these high-yield investments are not efficiently priced. That could happen because investors persistently have a growth bias in their investments. It could happen because there's career concerns, or in other words, benchmark hugging amongst investors holding large investment portfolios. High cash payouts are beneficial to investors because they constrain executives from making investments which increase the size of the company, but don't necessarily increase the value of the company. And it could be the case that investors persistently understate the disciplined benefits on management of high dividend payouts. So the questions we want to address are, what is the historical return premium from high yield portfolios? Do fluctuations in economic conditions affect performance? And what are some of the risks facing investors if they just try to rank stocks on the basis of high dividend yield? And what we're going to see that in Australia, in terms of inflation adjusted pre-tax returns, inclusive of the benefit of imputation credits, there's been a long-term return premium of 2.3% over the last 41 years. And there are a couple of specific risks that we want to talk about. There is below average market exposure from high yield portfolios, and there is above average interest rate risk exposure. We're going to see that returns vary over time, and that's going to be consistent with any style-based investment strategy. And we're going to look at the potential 12-month forward-looking yield of 8%, inclusive of imputation credits, from a well-diversified high-yield portfolio. As for this presentation, we didn't want to focus only on our portfolio. We looked at 4 high dividend yield indices, which are available for investors to observe the data from in Australia. We've got at the bottom of this table, information compiled by Professor Ken French from Dartmouth University, who is well regarded as looking at value-based investment strategies over time. And on his website, there's data available from 1983 to December 2022. We've got our own index, and we've got indices compiled by S&P and MSCI. And we average the monthly return from those indices to strip out the idiosyncratic portfolio formation rules of each index to estimate a pure yield premium. And what you see on the chart is the growth in the value of $100 over 41 years on an inflation-adjusted basis, including the benefit of imputation credits. And you see that over 40 years, 4 decades, you have a 2.3% inflation-adjusted premium, of which 1.2% comes from imputation benefits, with the remaining 1.2 to 1.3% from a pure yield premium. So in the long term, high yield investments beat the broader market. So what we've seen is that on average, over 41 years, investors, if they had invested in high yield stocks within, would have earned an inflation adjusted return, including imputation credits, of 2.3% per year. But unfortunately, investors don't get to live multiple lifetimes. Investors holding stocks have 7 to 10 year horizons typically, because it's a fairly risky investment. So it will be important to know what is the potential for underperformance over a reasonable investment horizon of 7 to 10 years. So we broke down our 41-year period into 6 economic regimes. And take a look at economic regime number 5, and that runs from July 2013 to January 2020, the onset of the COVID-19 pandemic. And over that 7-year period, the high yield average portfolio actually lost 2.3% relative to the broader market. High yield stocks put on 7.9%, the broader market put on 10.2% in inflation adjusted terms. So there was still a high return, but there was underperformance. So investors really need strategies to try to mitigate the potential for that underperformance. And one reason for the underperformance of this particular strategy over that particular regime is that, remember, we're averaging 4 indices here to isolate yield and strip out idiosyncratic variation. Well, 3 of those indices place a material weight on historical dividends in forming a high yield portfolio, and they're not rebalanced very frequently. And when you do that, you potentially fall into a dividend trap, assuming that past dividends are a good expectation for future dividends. So you always want to be forward looking. In addition, you have to be cognizant of interest rate risk. High yield portfolios have 2 offsetting risks. On the plus side, they are somewhat defensive. A 10% fall in the market is only associated with an 8.5% fall in the value of a high yield portfolio. Or in statistical terms, high yield portfolios have low beta. However, high yield portfolios, they trade a little bit like bonds. For a 1% increase in the 10-year government bond yield, there is a minus 0.6% return to a high yield portfolio. So below average market risk is offset by above average interest rate risk. So let's think about risk mitigation. There are 2 ways to form a portfolio that trades according to high yield. The first approach is you rank all the stocks in your investment universe by dividend yield. The second approach is to rank all the stocks in your investment universe by dividend yield, but within each industry. Let's look at the characteristics of portfolios formed according to those 2 approaches and see what the current characteristics are at the end of June 2023. First of all, if you ranked stocks in the All Ordinaries Index by their yield including credits, irrespective of industry, you would be looking at a 12-month prospective dividend yield including credits of 9.4%. That's very high. But on the downside, the 1 to 2 year prospective earnings growth is minus 9.1%, and you would have 96% of your portfolio invested in 3 industries: basic materials, finance, and energy. You'd have no healthcare, consumer staples, technology, telcos, or utilities. So there is this very high interest industry exposure. Alternatively, suppose you ranked stocks by yield within each industry. If you did that, and again taking the top 25% of stocks by market capitalization, you would have a portfolio which had a 12-month forward-looking yield including credits of 8%, earnings per share growth approximately flat, down 2.4% over forecast years 1 to 2, and only 54% of your portfolio in the top 3 industries of financials, basic materials, and industrials. You'd have 29% allocation to healthcare, consumer staples, technology, and telecommunications. So in conclusion, we know there's a yield premium consistent with overseas evidence and consistent with a very long time series over 4 decades. That premium in Australia has been 2.3% per year, of which you have roughly an equal split from imputation benefits and a pure yield premium. There are 2 risks to be cognizant of. There's below average beta, below average market risk, but above average interest rate risk. And importantly, for risk management, you have to form portfolios on a forward-looking basis so as not to be taken down the path of falling into a dividend trap. And importantly, be diversified across industries. If you just rank by yield, you will always be underweight healthcare. You will always be underweight tech. You will always be overweight mature companies in the basic materials and financial sectors.
Thank you, Jason. And that's very insightful into the dividend and the yield. We have some questions for you. The first question is, in pursuing a high yield stretch, and what is the most important pitfall investors should be aware of?
Well, the most important pitfall is over-reliance on historical dividends. You always want to be forward-looking. Take, for example, the big mining companies in Australia today. They are at the very peak of their earnings cycle, and analysts have factored into their forecasts. So the more, always use analyst forecasts and always be wary of the timeliness of analyst forecasts. If you have access to very recent forecasts, rely upon those, because remember, analysts are not updating their forecasts instantaneously. There's lots of stale data even in analyst forecasts.
Right. So when it comes to value-based strategies like dividend yield, they're sometimes described as a low turnover strategy. Is that right? Is that true?
I think that's a little bit misleading. So there is this idea that value-based strategies like buying high yield or low PE stocks or low price to book stocks, you're only turning over about 10% of the portfolio a year. But mathematically, it's just not true. Suppose you're trying to beat the market by 1 to 2% on average over an extended period of time. And suppose that your strategy actually works. So you do beat the market by 1 to 2%. Are we saying that only you can get the 1 to 2% incremental return relative to the market by only turning over 10% of the portfolio a year? Or in other words, is 90% of the portfolio just perennially going to beat the market? It can't be the case that you're buying a cheap stock, the price corrects to give you a return which beats the market, but then it's always cheap the next year and cheap again and cheap again if you're always beating the market.
Well, thank you, Jason. Great to see you today. Take care.
Thank you so much. Bye-bye.
Coming next, we have two presenters from the Spatium Small Companies Fund. Their portfolio managers believe that there is a growing environment where equities are increasingly oversold and undervalued for short periods. They observe a phenomenon in the last 10 years that with the influx of popularity of passive products, major institutions' capital requirement, wider markets herd mentality, equities are prone to being sold off hastily. The Spatium Small Companies Fund seeks to identify these momentary mispricing opportunities and benefit from their appreciation. Today we have Jess Moors and Nicholas Quinn. They are co-portfolio managers of the Spatium Small Companies Fund. Jess is responsible for distribution and market research. Nick, on the other hand, focus on trading and portfolio construction. The topic today is exploiting short-term price dislocation, the case for Australian sophisticated investors. Welcome, Nick and Jess.
Thanks for having us, Angelina. So yeah, as you said at the top, we're excited to be able to deliver this presentation on how we've seen the growth in short-term mispricings in the Australian small companies segment that we seek to exploit with the Spatium Small Companies Fund. I'm Jesse, this is Nick.
Hey guys.
And yeah, we're keen to deliver this presentation. So jumping right into it, it's probably worth us, we'll just go back one. It's probably worth us framing a little bit as to how herd mentality and these short-term price dislocations go, I guess, hand in hand. As we know, social media has taken over our modern lives. Everyone's addicted to their phones now, Android or Apple, looking at Twitter, LinkedIn, Instagram, whatever have you, about tips and tricks as to stocks that might be of interest to retail investors. This herd mentality is amplified through social media because you've got people like Elon Musk, who can, very early on through the COVID period was able to, I'm not sure if he would call it influence, but he did influence the price of Dogecoin by calling it that it was going to go to the moon. It was something that people should invest in and was a big supporter of cryptocurrency. But what we've seen through this period is as you get more public people onto these platforms, people that develop a following, they're able to influence particular stocks or particular asset classes through their position or their perspective on that particular asset. Interestingly, when you then start to look at the data a little bit more, and this is here where we talk about a bit about the buy side and sell side commentary, that if you look at an analyst's, The Economist actually did a really good piece of research on this in the late 2018, 2019, that if you look at buy side analyst ratings, 94% of their ratings will be a buy or a hold, only 6% will be a sell rating. Now, naturally, the first question is, why is that? Well, because analysts need access to be able to get into these companies and speak to the CEO and speak to the strategy and speak to the management of those companies. So you're not going to necessarily, or you'd be less inclined to give it a sell rating if it means you no longer have that access to that company. So there really is a shifting momentum, in our opinion, of more commentary that leads towards why you should buy, why you should invest, why you should hold particular companies or assets versus those that say sell. So you can see through the very basics of how herd mentality works, why it drives these aggressive swings in the market. And then if we move on into something that's a little bit more broader for everyone, at least at this point in time, is with ETFs, as you said at the top of the introduction, Angelina. ETF products have grown extraordinarily, and people can read, and you can see there on the screen. But and as at the year 2000, there was only 100 ETF products, and now we have over 8,700 ETF products globally. And they're in everything from oil to gold to crypto to particular segments of the market, whether it be global smalls or Aussie smalls, what have you. And it really is shifting the momentum in those markets, purely on the basis of needing to hold an equally weighted exposure to that particular asset class or to that particular segment to reflect the underlying assets in that ETF. So that in itself, unfortunately, doesn't result in a lot of traditional price discovery that a lot of fund managers would have done in the past to be able to build a portfolio that they think is going to exceed their selected benchmark. So what you have is companies being sold off unnecessarily, purely so that ETF, let's say it's a gold ETF, and they're selling off gold company A and gold company B so they can buy a little bit more of gold C and gold D, purely because they need to mimic how that benchmark has reflected over the last month or the last 3 months or the last 6 months, however often they rebalance. So this is our case. This is our argument to the market. This is our thesis, that with more ETFs, more passive money, lack of price discovery, as you said as well, Angelina, the introduction, or rather the growth of major institutions needing access to capital, it's creating these frictions in the market and these short-term mispricings that we believe we can capitalize on. And then that naturally feeds in quite well to the Spatium philosophy here, that with these influx of products, we're able to find mispricings in the market on a short-time basis that we believe we can capitalize on for all investors in the fund. So I'll pause there and I'll pass over to Nick.
Cool. So this is our performance lifetime. Conscious this is our end of May data. However, we do have the end of June subject to finalisation. So the fund return history profile is at 5 years now. It's been quite a journey along the way. As you can see, some significant bumps throughout the back end of 2018. Naturally, COVID, which we all remember and some of us wish to forget. And obviously, most recently, the Ukraine dilemma that we're hoping for a quicker than expected resolution, but it doesn't seem it's going to go that way at this point in time. So quite proud of our results. As Jesse touched on earlier, that the swing from passive money, the swing from active money to passive money has been astronomical over the last 25 years. And in our opinion, too far in one direction. And there are these daily opportunities for us to go out and look for businesses that have dislocated from their peer set, and in our opinion, on an unfair basis. The biggest differentiator of the Spatium Small Companies Fund compared to possibly other small companies funds out there is that our high turnover rate allows us to buy companies and hold them for only 30 to 45 days on average. We're moving in and out of positions, moving in and out of companies, and as Jesse touched on earlier, we're ignoring a lot of that buy versus sell side research that's put out there because we believe it's heavily influenced by probably instances that don't reflect the company, but more reflect society at large and needing that access. So we've sort of discounted that out. We like sticking to our knitting, and we're saying that primarily by what we do is that we're diverging businesses that are away from their peer set, and we think that there's an opportunity there, that there's an overreaction by the market and they're temporarily oversold or possibly temporarily undervalued, which then leads into our investment strategy, which we'll jump into now.
Well, I'll give a very quick high level of how our strategy is or integrates. So as you can see there on the screen, we have 4 key stages. Stage 1 is the bulk of our work, where we're filtering through end of day adjusted data to determine the companies that we believe through stage 2 are undervalued, that we want to add to the portfolio, those we want to look at further, and those that we think, in our opinion, are fairly valued. Portfolio construction at step 3 is crucial. We are building an equally weighted book fully deploying capital or nearly fully deployed capital. I think we have a few $100 in the account at the moment. So that's fundamental to make sure that we build a portfolio that can weather the storms on both fronts. And then stage 4 is how we exit. But I'll pass back to yourself, Nick, for stage 1. Oh, sorry, stage 1.
Sure. So for us, this is a multi-step approach. As we touched on earlier, we're looking to screen out businesses that are possibly overvalued and unlikely to be a temporary dislocation to profit from. And so we're doing this in a reverse order. So we're screening out businesses that we say, right, they're doing quite well. Step 1 is the macro filter. We're looking at all 300 companies on the ASX 300 and saying, right, which of these businesses is doing really, really well lately and is unlikely to be a short-term dislocation, and we'll screen those out. The second step for us then says, okay, you might have a business that's underperforming the wider market, the ASX 300, but compared to their peer set, they're actually doing really, really well. It's something we'll also look to pass on there and maybe not take another look at. The third step for us is the small company filter, getting the distillate between, obviously, there's such a high concentration of financials up the top end of the 100 and saying what's actually going on in the Australian engine, and is it likely that this business is temporarily oversold compared to its peers? And that's the third step for us. Fourth step for us is the decay horizon, which then touches on how long has this business been separated from its peer set. If this has been separated for 12 or 24 months, the chance that it's a temporary dislocation is low. A business that's been dislocated from its peer set to 7 to 28 days, well, that's very exciting. And then we move into the last pass, which is the hurdle rate that says, how much fat do we need in this business to make it worth our while to get into? Stage 2 for us, which we've touched on already, breaking apart those businesses and saying what kind of valuations can we attribute to these, and how likely is this to be separated from its peers, allows us to then separate which businesses we want to buy in stage 3. Stage 3 for us, as you can see here, a bit of a heat map model. We have our businesses that we say, right, we're willing to go in and buy these companies. We think they're temporarily undervalued. This is the price we're willing to pay. And the same is true on the back end that leads into stage 4, which says, these are the prices we're willing to get out of the company for. However, we won't jump out of the company unless we've had another new position that we're willing to get into, as Jesse touched on earlier, to make sure we stay at that low cash weight and have our investors' capital deployed at all times.
And that's essentially us, Angelina.
Thank you, Jesse and Nick. That was a wonderful presentation, and you explained a few concepts really well. And now I do have some questions for you. The first question is, what makes you different from other Australian small cap investment strategies?
I'll take this one.
Sure.
Well, I think as Nick touched on earlier, Angelina, where we differ from our peers is that we have a relatively higher turnover rate of our portfolio by volition looking for those short-term mispricings in the market. So where a lot of our peers might look to buy and hold a book for a suite of companies for 12, 24, maybe 36 months, potentially even longer, we're looking to buy a book that we believe at this point in time is temporarily discounted to their peers and to the market. On average, that will result in a turnover of the full portfolio every 30 to 45 days. So not a hard and fast rule necessarily, but it is something that by volition of trying to continually find those short-term mispricings, we do have that natural turnover. But as Nick has touched on in the performance slide, it's done very well for our investors and for clients, and something that we will continue to pursue for definitely the long term.
Thanks, Jesse. It seems that the timing and this active management is really critical to how you manage your portfolio, make your decisions of buying which book. So that is a segue into my next question is, in terms of your strategy, what investment environment suits your strategy best?
It's a great question, Angelina, and something we quite proud of, that our fund has typically done well in higher volatility climates, which is often the climate that most other investors are heading to the exits. We've done particularly well during the back end of 2018, as we know the housing market slowed down. We've also done pretty well during COVID that year. The XSO went up 6%. We went up 32% that year, as we were able to find so many dislocations. We've just finished off a great end of financial year last year. The market went up 5%. We've gone up approximately 22%, as we touched on earlier, pending the trustee finalising end of June numbers, but that's the approximate at this point. That's significant alpha figures have been delivered to the clients, and they're quite happy with, and quite happy to park their capital with us when things are going a little bit crazy. And that's, as we said, when we find more of these dislocated opportunities, And with what's going on in the world at the moment, we look forward to the next couple of years, hopefully finding many, many more.
Seems to me that volatility is gold to you, in a sense.
Absolutely.
Absolutely.
Yeah. So how do you manage your cash levels? Just out of curiosity.
So for us, our biggest tenet is to never be sitting in cash. We have within our IM that will be less than 3% cash. Operationally, we always market that we're less than 1% cash, but functionally within the business, we have a couple $100 sitting in cash. Our internal sort of mandate is if we have $1,000, we'll go and deploy that. So we're always next to 100% fully deployed. And how that works functionally is we then look at, okay, so we've entered into these companies. We've said we're willing to buy it at, say, $12.40. We're willing to sell it at $12.65. Very different to other small cap peers that we might hope to buy for $12.40 and sell for $30. We're making these 1%, 2%, and 3% movements over and over again over a 1 month period. Doesn't sound super exciting once, but when you do it 12 times in a year, it adds up to quite a margin. And then we say, right, well, we've got the business to $12.65. It might be trading at $12.68. We would be willing to get out of this business if we have a new business to deploy that capital into, to make sure our cash weighting is very, very minimal and stays under that 1% at all times. Functionally, that means for us going and then saying, right, we want to get rid of this, and this company. We might sell 25,000, 50,000 of that one, or maybe 75 or 100,000 of that one, frees up some of that capital, and then use that money as that's flowing in throughout the trading day, and then buy into maybe this company over here and that company over there. And sometimes you get to the point where you've run out of new buy opportunities, you've filled them up, if you like, to a certain point where we are equally weighted within the book, so we don't have any favourites. And the businesses that we hold, we like having nice and evenly. It spreads our risk quite well. That we say, right, well, we've got a couple of sales, but they might just have to sit there. And the same in reverse. Sometimes you've got ample buying opportunities and a limited number of sales, which means you can only partially fill those buys. Again, maximising that equally weighted approach as best possible. But naturally, it's the stock market. Some companies move up and down more than others. So there is slight variances in that. But we do try to stick to that as hard as we can.
Why not maximize the capital and deploy it to the best use?
Absolutely.
Well, okay. Well, thank you. Sorry?
No point sitting on the sidelines.
Absolutely.
Yeah.
Oh, thank you, Jesse and Nick, for presentation and Q&A today. It's great to see you today, and all the best. Now, our next presenter is from Elston Asset Management. Elston Australian Emerging Leaders Fund manages a concentrated, high-conviction, quality-focused portfolio of companies outside the ASX 100. Our speaker is Mr. Gary Merkel, the Associate Portfolio Manager of Elston. Gary's topic today is why should you be looking at quality Australian small cap? Welcome, Gary.
Thank you. Yes, my name is Gary Merkel. I'm an Associate Portfolio Manager at Elston Asset Management and one of the team members from the Elston Australian Emerging Leaders Fund. Really appreciate the opportunity today to present. The discussion topic we are presenting on is we think the time is right to invest in a fleet of quality small companies. Said in other ways, we think the time's right to be looking at small cap ASX with companies that have quality attributes. Before we begin, this is just a standard disclaimer. This material has been prepared for general information purposes only and not as specific advice to any particular person. So we wanted to set the stage by making a case for why quality small caps are a good investment on a standalone basis. Firstly, hopefully everyone's familiar with the small cap premium. There's been a lot of academic research in the past that has looked into how smaller companies can outperform. Similarly, there's been academic research around how quality companies also tend to outperform. So we think combining those two factors are a good exposure to have for long-term investors. I also wanted to note that, particularly for the ASX, the smaller end of the market is an under-researched universe. There's not a lot of analysts cover the companies in this part of the market. And so we think that creates pretty substantial disconnects between market prices and intrinsic value, which is really good for the diligent investor that's willing to do the work And then finally, we take a concentrated portfolio approach. We think you can get an adequate level of diversification with as few as 20 to 25 holdings. The reason why we like this sort of concentrated portfolio approach is it allows us to maintain a very high level of quality in the portfolio, and it also allows you to fill the portfolio up with really your best ideas. So there's a few academic papers that are listed at the bottom of this slide for anyone that would like to do any sort of follow-up reading around diversification and portfolio concentration. So it shouldn't come as any surprise that small companies and the economy more broadly are facing pretty big headwinds at the moment. Very high levels of inflation, increasing interest rates, the war in Ukraine, fluctuating asset prices, and potentially a softening consumer. This has led to a very volatile year for the small ordinaries. So if you look at the bar chart on this slide, the light blue is the XSO, which is the small ordinaries index, and the dark blue is the XTO, being the ASX 100. So there's a couple of interesting things to note. Firstly, calendar year 2022 was one of the most volatile years over the past 20 for the small orders index. But more interestingly, the differential in volatility was the biggest in the past 20 years. And that sort of segues us into this next chart. So what we've done here, we've grouped the index into buckets. So you've got the top 50 being that darker orange, the mid 50 being the grey, and the gold yellow coloured line being the small ords index. And as you can see, the top 50 has held up really well since December 2021, when the outlook for inflation and monetary policy changed pretty materially. The mid-cap 50 had a pretty significant drawdown through to June 2022. The post that has recovered pretty well. The small ordinaries index sold off more aggressively, and then it's really range traded off the bottom. So we think that this shows that there's been risk off in small caps, and there's a pretty material sort of discount that has emerged as investors have sort of taken cover in the larger counterparts. And we think it's presenting a tremendous opportunity. And this next slide also looks at it, the ASX 100 relative to the small ordinaries, and we're looking at it from an earnings perspective. So it's the relative PE between the top ordinaries, and this is also suggesting, when you look at it from an earnings perspective, that the small ordinaries is trading at a discount at the moment. Further suggesting that there's a pretty good discount and opportunity that has emerged in this part of the market. So far we've talked about the emerging discount within the small ordinary space relative to the broader market. Now we wanted to move to why we think companies with quality characteristics are best suited to deal with the macro headwinds that we had alluded to earlier. And it really sort of starts with the sustainable competitive advantages that high quality companies tend to have. That allows them to invest capital at high rates of return, which typically leads to taking market share and generating high organic growth rates, which is, we think, really important in potentially what's going to be a low growth environment as the economy slows. They also are generally able to generate high gross margins, which is really important when you're dealing with fluctuations in input prices. So it allows them to sort of manage the inflationary pressures better. Strong pricing power, that's been something that's been very evident over the past 12 to 24 months in the quality companies that we follow. They've been able to push on those inflationary pressures quite well and sort of manage their margins. And then finally, quality companies tend to be capital light. So, conservative balance sheets, low levels of gearing, this reduces the risk of higher interest rates, creating a greater sort of debt burdening obligations for these companies. There's a lot of their counterparts that will be feeling the pinch from higher interest rates. That's not the case for quality companies. They'll be able to manage that quite well. So on this slide, we've listed 6 high conviction ideas, high quality companies, Temple & Webster, Nanosonics, Audinate, Polynovo, Megaport, Breville. They have all the characteristics that we talked about on the prior slide. We think these businesses are really well positioned to manage their way through the economic challenges over the next 12 to 24 months and come out the other side stronger. One company that I would particularly suggest having a look at would be Audinate. We think that they've got an incredibly strong, sustainable competitive advantage, and the opportunity ahead for that business is really appealing. But after this, if anyone would like to talk about these companies or any of the other companies that we hold in the portfolio, we'd be very happy to chat. And then just to finish up, I wanted to introduce Elston for people that aren't familiar with the business. Now, Elston's navigated ups and downs for over a decade. When I joined Elston, it was back in 2015. We had less than $1 billion in assets under management at that point. Since then, the assets under management have gone up 5-fold, which I'm tremendously proud of the success of the business. And there's a lot of factors that have contributed to that, but we like to think that it's the growth mindset and focus on continual improvement that the business has that has really sort of been the driving force behind the success of the business over that period. Today we've talked about this presentation has been in relation to the Elston Australian Emerging Leader Strategy, which is actively managed small cap strategy, quality focus, long-term fundamental approach. It's concentrated with high active share. But we wanted to also highlight that we have other Australian equity capabilities, being in the Elston Australian Large Company Strategy, which is style neutral, top 100 strategy, low cost, transparent, actively managed. It works really, we think it fits really well as a core exposure within an Australian equities portfolio. And we also think that it blends really well with other small cap managers and long short managers. And then just finally, just wanted to finish up with this photo of the broader asset management team. It takes a big team of skilled and experienced people to deliver high quality investment products. So on that note, just wanted to thank everyone and pause for questions.
Thank you, Gary. I do have a few questions for you. You mentioned quality a few times in your presentation, and we see different interpretations of quality in the market. So what does quality really mean to the Elston emerging leaders?
Yeah, that's a really interesting question. So if you look at quality from a quantitative perspective, it's generally high returning businesses with high gross margins and conservative balance sheets that are characterized as quality. But the issue you have with that is it's all backwards looking. And so we have qualitative and quantitative attributes that we look at to assess whether or not a business is going to be able to maintain quality throughout our 5-year investment horizon. And so some of the things that we look at is supportive industry structure, wide moats. We look for businesses with financial strength, so conservative balance sheets, robust organic growth rates, good management, good corporate culture, and generally we try to avoid businesses with ESG risk.
Mm-hmm. And in your portfolio, I see that you hold some consumer-facing type of businesses. Do you have a concern about a slowing consumer environment?
Yes. Look, it's an incredibly dynamic environment at the moment. And, we like to sort of prepare for, a badder scenario. So, we are forecasting and expecting a pretty challenging period for consumers. But the consumer-facing businesses that we have in the portfolio, all have structural tailwinds and robust balance sheets that, really give us confidence that they'll be able to sort of navigate their way through this challenging period, and then come out the other side stronger. And we think the ones that we hold in the portfolio will make a very attractive return over our 5-year investment horizon.
Well, thank you, Gary. Have a good night. Great to see you.
Thanks for having me. Really appreciate the opportunity to talk.
You're watching the first nighttime webinar of Investment Markets Investor Webinar, focusing on the Australian perspectives. Our next speaker is Andrew Dale, partner and portfolio manager from ECP Asset Management. The ECP Growth Companies Fund invests in a concentrated portfolio of high-quality ASX-listed businesses in the growth phase of their life cycle. As an all-cap strategy, the fund can invest across the market capitalization spectrum to take advantage of mid and small cap opportunities in addition to larger companies. Andrew is going to talk about quality and growth, the narrative and the numbers. Welcome, Andrew.
Thank you very much for having me. And it's great to be here with you all to talk about the markets, particularly in these. But as pointed out, we're going to focus on the quality and growth segment of the market. I'll just draw your attention to the disclaimer here. Please have a quick look at that. If we look at ECP Asset Management, I'll just give you a little bit of a high-level understanding of who we are. Firstly, we were founded over 10 years ago by Manny Pole and Jared Pole. I joined the team shortly after, and we're very much a fund dedicated to high-quality investing, very high conviction investing also. We've built the team over time to 9 investment professionals and 2 distribution, and we've created a good track record over the period that we've been in operation. Here you can see the team, a good sort of range of people and diversity. We've also got a really good range of industry experience, people from engineering, people from banking, people from software, people from different parts of the market that help to contribute to a diverse thought process. One of the key questions, I think, when looking at fund managers is, how does a firm or how does ECP differentiate itself from others? Now, this is a difficult question to answer in an industry which is essentially quite homogenized. Most fund managers are looking to invest money into stocks and gain alpha, and it's quite hard to differentiate. But when you look at ECP, I think there's a combination of factors that help to set us apart. Firstly, we've got a very decentralized model. We have no key man risk. You'll know that in the past there have been funds where there have been a key 1 or 2 individuals that have really driven the performance of a fund, and if there's any issues with those people, there can be issues with the fund and the flow of funds going forward. We don't have that here. The firm is 100% owned by staff. There's a rigorous research process, which we don't just talk about. That is a 3 to 4 month period of time required to get a stock in the portfolio. So there is a genuinely deep period of understanding of the company before it's added to the portfolio. We've also got a holding period, which is in excess of 5 years, low turnover, 30% indicated there. And it's very much a high conviction concentrated fund with intense scrutiny from the analysts themselves. So what is growth investing to ECP? Well, growth investing really is focusing on the economics of the business that drives long-term returns. If you look at this chart here on the right, you'll see that we're looking for companies in that growth period of the cycle. That typically also means we're looking for companies that are in industries that are growing. Industries that are mature tend to offer less opportunities for companies. So we're really focusing on things where there is a growth in the industry and a company that is doing well within that. These companies tend to be capital efficient, and they also have strong balance sheets. So part of our process metrics require that a company has at least 5 times interest coverage, because we find then that they have capital to deploy into future growth opportunities going forward. Now, some of these companies will move into the maturity phase of the life cycle, and that is when we continue to own them. However, we do put more pressure on an investment case when they're in the mature stage of the life cycle, and more often than not, we divest out of those companies. So often we're looking for inefficiencies or areas where the market is not properly assessing the quality and growth of a company going forward. One section I'll look on a little bit later, but in the healthcare segment of the market, is a great example of how the market tends to focus on short-term valuation metrics and then being quite negative on the opportunities, and they don't take into account the sustainable opportunities long-term for those companies. We're really about looking through those short-term valuation metrics and focusing on 5-10-year cash flows to try and ascertain a high-quality business. So how do we define quality at ECP? Really what we're looking for when we do our detailed research analysis is we're trying to assess and work out whether the company has a sustainable competitive advantage within the industry they operate in. Part of doing that is trying to assess whether they are a quality franchise. And you'll see here on the right, the 6 pillars of a quality franchise as we denote them. And going through those, we're looking for industries that are growing, as already discussed. We're looking for high quality businesses within those industries, competitive environments where the company that we're investing in is well placed to continue to grow, strong financial strength, and also sustainability. More recently, we've focused heavily on management, and particular the culture that a company has. We believe that high quality cultures within an organisation really help to drive long-term fundamentals, and we spend a lot of time assessing culture to ensure that a business is on the right track, because with a good culture, we believe most businesses can achieve anything. I want to focus on a couple of examples now. If you look at realestate.com, I always think it's an interesting stock to look at. Most Australian people particularly have a view on the real estate sector. This is a company that's been in operation now for a very long time. In actual fact, since listing, it's delivered over 2,500% return. Now, a lot of that was gained in the first 5 years of its listing. In recent years, you'll see the growth of the share price has been over 200% since we've had it in the portfolio. The metrics in the table on the top right show that while it has had very strong earnings history, that we are expecting double-digit growth going forward. Importantly, that the return on equity is around that 30% level, which is something that we're really focused on. It is moving more into the maturity phase of its life cycle, but we still believe it has a number of levers that it can pull to continue to drive its overall earnings. The stock currently has an IRR, according to our system, of 8.8%, which means that it's slightly lower than our overall portfolio of about 14 to 15%, hence the weight is a bit lower. If you look at the competitive advantage of a company like REA, really it's centred around its physical competitive advantage, which means its market share, denoting around a 60 to 70% market share in its category. It continues to innovate and bring new product and new ways of driving returns, and financially it's superior to its competitors. The next bucket of stocks I want to look at is the healthcare category. Now, when we look at healthcare at ECP, we tend to focus on device manufacturers. The reason we look at device manufacturers is predominantly because they have very high market shares in the Australian market. They're also capital efficient and they continue to drive innovation. If you look at the companies like Cochlear, ResMed and Fisher & Paykel, which are very device driven, all of those companies have market shares in their primary products of around 70%, which really helps to drive earnings growth in the long term and also helps to deliver us that ROE of in excess of 20%. If you look at the bottom right chart, what we're displaying here is at the time of acquiring these stocks into the portfolio, they were all on a negative rating by most sell-side brokerage firms because they were looking only at 1 or 2 year earnings forecasts. Fortunately, at ECP, given our longer dated earnings focus on a 5 or 10 year basis, we're able to look through those short-term metrics and we're able to invest in companies like these. And you'll see on the chart on the left, all those companies are up between 2 to 3 to 400% over the period that we've held them. So I want to leave you with some thoughts, and that is that at ECP, we truly believe that high quality businesses are the place to invest. We focus a lot of our research time and intensity on the companies within the portfolio, and I think this is an important thing to remember. The companies you own are the ones you must understand well, and you must do lots of research on. We're always looking for new ideas to put in the portfolio, but we must get the existing ones right first. If you look at the next slide, this is some details about the ECP Growth Companies Fund. You'll see all the details there about how to invest. We are working with a number of partners in both distribution and consulting to help promote that product. And we also work with our partners who have had a long-time relationship with Copia, and you can see the details of the people there to contact in order to get exposure to the ECP fund. Thank you for your time today. I appreciate it, and good luck out there investing.
Thank you, Andrew. Now, you talk about those very special companies with quality and growth characteristics. So how does ECP's ability to find these companies change through the economic cycle, particularly given that we're in a rising interest rate and inflation environment?
You look, clearly over the past 12 to 18 months, interest rates have been a key focus for investors in the market. I think wrongly the market quickly discounts growth opportunities given rising interest rates, but you do have a scenario where now investors do have a range of opportunities to invest their money in multiple places. I mean, it was only a short time ago that you couldn't put money in the bank and generate a return. Now you can get anywhere around 5%. But what a rising interest rate market does is it really polarizes high quality businesses, and it discounts the ones that don't have high quality franchises. A really good example of this is a stock that's in the portfolio, and that's Xero, the accounting software company. That company's been around for quite a while. It's got a very good business model, very good customer base, very good penetration into its markets, and has done really well over the past 5 to 6 years. But not until recently did the strength of that business model become apparent. With a new CEO and leadership team in place, they've been able to tweak their business model or the payment mechanism for their product, and that the company has gone on to perform incredibly well in an environment where interest rates continue to rise. In fact, that stock's up 60% year to date relative to the ASX, which is near on flat as we speak. So I think that really a rising interest rate environment, and also some macro cyclical factors that put downward pressure on overall growth, really makes high quality growth companies even more important, because they will be the companies that outperform over the long term, while those untested franchises will suffer as capital becomes less freely available.
Well, thank you, Andrew. It's great to see you. Take care.
Thank you very much.
Coming next, we have the Chief Investment Officer and Portfolio Manager of Prime Value Asset Management, Mr. S.T Wong. The Prime Value Opportunities Fund aims to deliver strong absolute returns for investors with a focus on downside protection over the medium term. The fund is long only and invests in quality growing companies that are helped by strong management teams. The manager believes that an unconstrained approach and a focus on identifying individual stock opportunities across all sizes, large, medium, and small, offers the best investment outcomes. The title of ST's presentation today is When What Lasts Matters More Than What's Fast. Welcome, ST.
Great, thanks for the opportunity. It's definitely an interesting time in the markets. We are mid-year, roughly at this point, just before reporting season. And as you mentioned, Angelina, I manage the Prime Value Options Fund, which is a absolute return fund focused on wealth creation over the medium to long term with a strong downside protection. So to maybe kick it off is to give you some context as to who Prime Value is, the fund itself, and the way we manage the fund, our beliefs, and certainly we want to overlay that to how we're looking at the market from a longer term perspective given the market environment. So with that, let me give you a short rundown of who Prime Value is, and to give you a flavor as to our philosophies and beliefs. We are a boutique fund manager based in Melbourne. We've been running equity funds since 1998, owned by a family office, and we have a well-resourced investment team looking into equities, Australian shares, but also from a broader perspective into other asset classes such as agriculture, infrastructure, private equity, and fixed income as well. So broader offering from a family office perspective. So that's who Prime Value is. The Options Fund, as you mentioned, Angelina, is an absolute return focused fund. Just a few highlights as to how we invest, because the primary objective really drives how we look at markets, how we select companies, and certainly how we position ourselves to create wealth for our investors. And that's been the case pretty much for the last 25 years. which has been the duration of when private has been operating its equity funds. So really our beliefs, we really believe that returns from markets or share markets are really driven by investing in companies. So we don't really look at benchmarks as a measuring point, but we also believe that minimizing mistakes is just as important as finding the winners in a market. Certainly as you do the math, if the value of your share fell by 33%, it'll have to rise by 50% to get your dollar back invested. So minimizing mistakes is certainly a core part of how we invest, and certainly drives our investment philosophy and objectives from a perspective. The fund, the Options Fund, has been running since 2012, is recommended by Zenith and Lonsec as well. So basically recommended by both the two larger investment rating houses. As Angelina mentioned, absolute return focus, looking to minimize risk, but looking at the most attractive options. And what we mean by that is that we're looking across the full market spectrum from small companies, medium-sized companies, and large companies to generate our returns for our investors. So that basically is the fund. The unique strategy for this fund is that it is structured across 5 categories or buckets, and you see on the slide here. And it's a strategy which we feel has been relevant over the cycle. So we invest in core companies, and we overlay that with specific growth companies, turnaround companies, valuation companies, and thematic companies, some of which I will share my insights as to how these companies fit into the portfolio per se. We are an active manager, so we don't buy and hold. We do have a longer term duration, but what we found that over time, since inception of this fund, has been a fund which has been holding a diversified pool of investments. Consequently, it has been churning out, or it's been reporting consistently low risk to the market and its peers as well. So that's just an active manager perspective, but with much lower risk and a strong downside protection. So which is where we come in. At this juncture, as I mentioned earlier, we're about mid-year, just on the cusp of reporting season in Australia, but opinions are really split. At mid-year, investors are broadly based for an economic slowdown. And on the back of that, corporate profits are expected to decline. Interest rates as well appear to have peaked. But at the same time, share markets have been rising since October 2022, which was the lowest we saw in markets. And in fact, if you've used a traditional measure of what a bull market is, which is 20% up from its low point, it would suggest that US market is in a pretty much a bull market at this point. So very different opinions in the market, split as to an economic slowdown, corporate profits coming off, but yet markets are rallying. And on the back of that, we've got a few fast thematics coursing through the market. Buy now, pay later, a couple of years back. Lithium and EV or electric vehicles, largely a story of 2022. Coal as well has been a hot thematic for 2022 as well. Cryptocurrency seems to be coming back in the picture more recently. So is AI and the Chinese reopening story that was since back end of 2022. But what we're seeing at this juncture is that whilst market has tended to zig and zag, investors think things might be zigging, but markets have in fact zagged from where we started 2023. So really mixed opinions. And one key questions that we have from our investors is how do you invest in such a market where opinions are divided, the indicators are quite murky and somewhat uncertain? How do you, as an investor looking for strong medium-term returns from asset perspective, make sense of the markets and the stocks that you buy? So we're trying to answer that question for you in like next couple minutes, and hopefully we'll be able to do that in a succinct and concise manner. As I mentioned, inflation's been a topic since last year. Growth has been coming off economically and corporate perspective. And this is chart you see bottom left-hand corner, which is the ASX 200 P ratio, has been coming off, but it is in line with the 20-year average. But what's interesting is the chart on the bottom right-hand corner, which is the EBITDA margins of Australian top 300 companies in Australia, and that's been softening. That's been coming off back to its average ratio of about 23.8, suggesting that perhaps expectations are being wound back in the market. But as I mentioned earlier, markets are rallying. So how do we make sense of all this different dynamics in the markets per se? Really, my focus is not to focus on the shorter term aspect, but certainly from a longer term aspect, we're still seeing opportunities across a number of sectors in the market. And I'll share some of our insights with you. One of them is healthcare or demographic change. The aging population in Australia continues to be a thematic, which is continues to be, in our opinion, attractive from a longer term perspective. Now, in the near term, you'll find companies such as Regis Healthcare, which is an aged care company. Actually, its share price has been coming off on the back of COVID issues. Providers in the aged care sector has been curbed in terms of labor, and labor wages been rising as well. And part of the consequence of that has been profits has been impacted in the likes of Regis Healthcare. But in our view, the supply demand dynamics in the AHS sector remains really attractive. We're all aging, and certainly, as you see on the chart on the left-hand side, the number of aged care providers in Australia is actually declining from 1,121 in 2021 to about 805 at the end of last year. So providers are actually declining, but demand for aged care is actually rising because of the aging population. And hence, we think that companies such as Regis Healthcare, which has got a collection of really attractive assets, we think in the medium term, that will be really attractive from a share price perspective. And as you can see from the chart here, it fell from about $6 back in 2014, roughly down to roughly about $2 at this juncture. So I think in the medium term, there's really long-term upside to this demographic thematic, and specifically the likes of Regis Healthcare, which has got a strong asset base to build off. One of the other companies that we are looking for investing in the medium to long term are companies which are improving its business profile. And here we call out the likes of News Corp, which, just so you know, it's a large media conglomerate in the US with assets in Australia as well, including Foxtel. One of the key aspects we found where researching News Corp is that it is a company which has been improving its business profile from a number of aspects. It is diversifying its earnings away from pure newspapers or traditional media into digital media, and we think that's positive. We think that the risk profile of the business of the company is actually declining because of the diversity of its earnings space. And certainly from our perspective is one of the most unappreciated aspect of News Corp. It is an undervalued company from an asset perspective. So we think this is a company where it has got a number of undervalued assets, rising digital earnings or subscriber base, diversifying earnings, and as such, it has a much more robust business profile compared to where it was 5 to 10 years ago. So we plot here the chart, News Corp share price going back to 2013. We then started to look closely at the company roughly in 2019, when we sensed that there was quite a bit of change happening in the company. And these changes we're seeing on a positive perspective in terms of digital earnings diversity and certainly earnings robustness coming through. And that's why we started to initiate a position in News Corp in 2019. And we think the runway to earnings growth should be quite long duration. It has quite a long-term duration to it, and certainly quite comfortable holding onto the shares at this point or the medium to long term. The final company I'd like to share with you is companies within the consumer sector. One of the key aspects we've seen in the last few months is consumer spending coming under pressure. And you and I certainly feel that, the price of milk has gone through the roof. The price of insurance premiums, what we pay on car insurances and home insurances, has certainly gone through the roof as well. Investors are trying to work out how deep perhaps the economic slowdown could be. But our sense is that consumer discretionary and media companies typically are early in this declining phase. But the market is also quite undiscerning between companies. And as a result, we think that in the next 6 to 9 months, potentially, we think it introduces opportunities for investors in the medium term within the retailing sector. So the sort of companies we're looking for, traditional aspects, typically we look for companies with strong balance sheets, low debt, strong management, good market positions which they can build on. Companies such as JB Hi-Fi, I think, will be looking quite prospective in the next 6 to 9 months. We may not be there right at this minute, but certainly these are companies we're doing quite a bit of work on, with a view of taking a position in some of these companies as share price pressures potentially come under stress with the slowing economic outlook. To bring it all together, Angelina, is that through the cycle, the fund has performed well over numerous cycles, and here you can see the performance of the fund. Most importantly, it has protected investors' capital through the down markets, and you can see here on the chart on the right hand side, and that's really the testament as to how we invest, which is looking for strong businesses to invest in, held by great management teams, and hopefully we buy them at a decent valuation. And finally, my last words, I guess, is that we're looking at a somewhat uncertain situation or economic outlook at this moment, but certainly we're by no means negative or pessimistic. We're entering into the next 6 to 9 months with the attitude as we've always held, which is to select a portfolio of companies that are durable, that are well managed, understand what the risks are, and overlay whatever today's events are with the profile of the company. This really helps us to select the key ideas that populate our portfolio, and we're certainly working towards building out strong businesses, owning strong businesses through the medium to long term through a selection of strong companies for the portfolio. With that, I'll hand it over to you for questions.
Thank you, S.T. In the interest of time, we're going to ask you one question. So what is your approach to investing in difficult market conditions, and what are some of the key lessons you have learned?
Sure. Yeah, look, Angelina, it's always uncomfortable investing through difficult environments, but arguably, these are the best times to invest in. And when I think back, some of my experiences through the GFC, the Asian financial crisis, even COVID-19, for example, these are probably the best times to invest in when you're uncomfortable with the outlook. And that's because investors typically throw the baby out of the bath water, and it really introduces a number of companies to start to select, which goes back to my final point, which is when selecting portfolio companies or a company, I'm really looking for companies which are durable, strong business models that are really well managed, and management here accounts for a lot in what I look for. And certainly when they face risks, they certainly will be able to adapt and adjust to risks that are facing these companies. So the companies which I talked to much earlier in our conversation suggest that within Australian market, we're certainly not having a lack of ideas to sift through for the medium to long term. That's pretty much what the key lesson is. Investing in strong companies when times are uncomfortable, that's probably one of the best times to invest in.
Well, thank you, S.T Wong. Good to see you. Take care. Our last speaker of tonight's Australian Perspectives is the founder and chairman of Montgomery Investment Management, Mr. Roger Montgomery. Montgomery Russen's investment philosophy is guided by fundamental research and analysis. Small market capitalization companies are relatively under-researched, and when markets misprice securities, this creates investment opportunities. They seek to build a portfolio of high-quality, undervalued small and emerging companies with strong growth potential and likely to benefit from secular trends, industry change, and with substantial competitive advantages. Roger Montgomery founded Montgomery Investment Management in 2010. He has over 3 decades of experience in funds management and related activities, including equity analysis, equity and derivatives strategy, trading and stockbroking. Prior to Montgomery, Roger held positions at Otmanet, Jordan Fleming, BT Australia Limited, and Merrill Lynch. Roger is the author of best-selling investment book, Value.able. Roger also appears regularly on television and radio, and in the press, including ABC's statewide drive radio program, The Australian and Ausbiz. Roger's topic is why now is the best time to invest in small caps. Welcome, Roger.
Thank you very much. Great to be with you. Really appreciate the opportunity to be talking with everyone today. My presentation is really an argument for investing in small caps right now. Now, we only have a few minutes together, so I won't be able to present all of the data, particularly some really compelling arithmetic around why investing when PE ratios are low is almost certain to provide attractive returns, especially in small caps. We won't have time for all of that, but what I will do is I'll present the sort of the outline of the arguments for investing in small caps now. Our small cap fund, the Montgomery Small Companies Fund, is run by Gary Rollo and Dominic Rose, and they have a significant number of decades of small cap specialist experience. And so in the back of my mind, as I present to you, I'm thinking about what they're doing, what stocks they're interested in, and the fund that they manage. So with that, let me proceed. Very importantly, I don't know your financial circumstances and needs, so the information I share today is not specific individual advice, rather it's general in nature. Any returns that I talk about are past returns. They're not a reliable guide to future returns, and perhaps most importantly, if I speak about a stock, it's not a recommendation to go and buy that particular stock. It is a company that we already own, and so if you rush out and buy it, you'll be assisting us by pushing the share price up. And of course, I won't be coming back to you to tell you when we're no longer buying the stock or when we're selling the stock, so keep that in mind. So why small companies? Well, one of the big things that changed in Australia earlier this year is the Future Fund, our sovereign wealth fund, if you like, switched from having a very, very large focus on index funds and index investing to becoming a stock picker again by actually investing in active funds with a particular focus on small caps. So one of the arguments is that if the very successful and very large Australian Future Fund is willing to invest in small caps again, it's worth prosecuting the argument for doing so, or at least exploring why they might be doing that. Firstly, we can see globally, not just domestically, but globally, that we're looking at one of the widest dispersions between large caps or mega caps and small caps that we've seen in a very, very long time. In fact, we have to go all the way back to the tech wreck to find a period back in 2000, to find a period where small caps had underperformed by as much as mega caps, or just prior to the tech wreck rather. And you can see now the gap the dispersion, if you like, or the gap between the performance of small caps as measured by the S&P 600 index and the mega caps. And this is, by the way, just the largest 7 companies in the S&P 500. But you can see that dispersion is very, very large indeed. Now, typically what happens, there is a mean reversion. We'll talk about that in more detail. But what often happens is the large caps are pushed to a level, and we'll talk about why they've been pushed up as much as they have in just a moment. They get pushed to a level where their valuations or their pricing is no longer reasonable nor attractive. And so investors then move down the spectrum of valuation and perhaps the spectrum of capitalization to find companies with similar themes that are better value. And then they follow, they start to rise in price as well. And so perhaps that's a scenario that we're on the cusp of seeing. I don't know, but it is a compelling argument for investing for better returns in the future by investing in the cheaper small caps now. And locally, valuations are also extremely attractive. In recent months, investors have moved towards large caps because, number one, they're more liquid, obviously, and there's a sense of safety or a perception of safety there. And also, with expectations of a recession, there's a belief that the broader revenue streams being generated by large cap companies will render them more defensive. And so they'll tend to perform better if a recession does ensue. And we might have a technical recession in Australia, but I'm not sure we're going to have the kind of recession that I witnessed back in the early 1990s, when quite literally in Melbourne, for example, 1 of every 3 shops was boarded up. Unemployment was close to 11%, and short of tumbleweed blowing across the street, many suburbs in Australia were ghost towns, or many shopping strips in those suburbs were ghost towns. We're not expecting a recession anything like that. Remember, employment both here and in Australia, in the United States, is above full employment, and so any recession that we have is likely to be, by definition only, rather than that sort of experience that I just described in the early 1990s. Nevertheless, the fear of those recessions has driven many investors to large caps and consequently small caps, which are perceived as riskier and less liquid, and they're more leveraged to economic cycles, have been left behind. And in fact, if we look at the Australian data, and this chart shows it here, the gap, if you like, or the dispersion or the relative undervaluation of small caps is the largest it's been since the year 2000. And remember what I said earlier. If we're not talking, I should say, we're not talking about investing in the indices here. I'm going to be talking about individual small companies. And if you're investing in high quality small companies, it's worth remembering that the lower the price you pay, the higher your return is going to be. The higher the price you pay, the lower your return. So it makes sense to be a contrarian and to be investing in companies that are on the nose, so to speak, that are out of favour. And this chart shows that small caps are definitely out of favour, and the most out of favour relative to large caps that they've been in almost a quarter of a century. If we look at a shorter period of time, just over the last 12 months, then what we can see here is that in terms of factors, the worst performing factor has been being small. Simply being a small cap has been the worst performing investment or investment characteristic. And that will eventually mean revert. And we'll talk more about that in just a moment. So we've got global small caps relatively the cheapest they've been compared to large caps since 2000. In Australia, the same thing. The valuation of small caps is the relative cheapest it's been to the top 100 for a quarter of a century. And as a factor, smalls have underperformed the most of any factor, considering quality, momentum, growth, dividend yield, and so on. Just being small has been the worst burden for a company's share price in the last 12 months in Australia. And so now is the right time to be thinking about small caps, simply because they are relatively cheap. But I press the point that I'm thinking about high quality small companies, not just a shotgun approach, invest in small companies because they're small. You have to be investing in quality businesses. And by quality, I mean businesses with competitive advantages. Competitive advantages are measured by a high rate of return on equity, a sustainably high rate of return on incremental capital. The most valuable competitive advantage of all is the ability to raise prices without a detrimental impact on unit sales volume. So when I talk about investing in small caps, I'm referring specifically to high quality businesses, those that are generating high rates of return on equity. They perhaps have little or no debt. They have long runways for growth, large total addressable markets, and so on. Okay, with that in mind, what are the benefits? What are some of the benefits of investing in small caps? Well, firstly, there's something we call reversion to the mean in financial markets. They tend to revert. So if small caps are underperforming, at some point in the next 5 or 10 years, small caps will be outperforming again. They will outperform large caps. If you wait for that to appear, it will be too late. You'll be paying a relatively or absolutely high price for those shares. The time to be investing is when the market for small caps is mispriced on the downside, as I believe it is now. The other benefit, of course, is diversification. Given the massive underperformance of small caps versus large caps, clearly they're uncorrelated, or there's a low correlation to large caps. And that will stand an investor in good stead in terms of diversification, because if large caps go sideways or underperform in the next 2, 3, 5 years, and small caps outperform, that lack of correlation or that low correlation will benefit from a diversification perspective. And of course, we know that there's inefficiencies in small caps. Quite frankly, stockbrokers don't make as much money broking small caps because they are smaller. There are fewer investors who are interested in them, so they're not as closely followed. That can lead to mispricing and market inefficiencies, which we believe is the case right now. And of course, there's the potential for outperformance because small caps tend to be leveraged to economic recovery. I mentioned earlier, I think this recession will be a shallow recession. I've been saying that since November last year. I write for the Australian newspaper every fortnight, and in an article in November last year, I said the time to invest in small caps is now. It will be a good year for markets this year. That's certainly been the case for innovative technology companies. They're up, the Nasdaq's up over 30% this year. And I also said that I don't think we'll see a deep recession. We may not see a recession at all. Best case scenario or worst case scenario, I think, is a shallow recession. So once we come out of the other side of that, it will be risk on again. Investors will start wanting to adopt risk, and they'll be looking for opportunities amongst small caps, and we'll see that mean reversion play out. Ultimately, a balanced portfolio with a mix of funds that are invested across different asset classes, different sectors, and different company sizes is usually the best strategy for wealth creation. So I think now is an excellent time to be investing in small caps. A couple of companies that I think are worthy of investigation. I've got two here that I'm going to present. The first one is Macquarie Technology Group. We love this business. We know management very, very well. Gary and Dom meet with the Tudhope brothers frequently. And it's important to note that they are the largest single shareholders in this company. This is an operator of data centers. Data centers obviously leverage to the move, the enterprise move to the cloud, which is leveling the playing field for businesses, large and small. And so we're seeing a lot of smaller businesses and medium-sized enterprises move to the cloud. These guys are at the forefront of that particular trend. And there's a lot of talk of AI at the moment. Again, this business is leveraged to that because AI sits in the cloud. All those powerful computers that drive large language models are sitting in data centers. And those data centers need to be relatively close to their customers. And so geographically, it's important to find data centres that are close to those major customers, which Macquarie Technology Group is. They've doubled their footprint in a relatively short space of time. They're continuing to expand. And perhaps most importantly, we think that there's takeover potential for this business once they're fully developed and those data centres, those 3 major data centres that they own, are fully tenanted. It will become a property trust, if you like, with a very attractive rental yield that we think will be attractive to overseas pension funds, for example. We think that could be an exit strategy for the Tude Hopes when they look to exit. A second business that we like and is leveraged to one particular trend that we're fond of is Breville. Breville is priced like it's a retailer, but it doesn't own any retail, doesn't have a retail presence. It doesn't own stores. It doesn't lease stores. It is a designer, an inventor, and a manufacturer, and it sells through other retail stores. In the United States, which is where we think much of its growth is going to come from, it's leveraged to the trend of the home barista. In Australia and across Asia, for example, we're familiar with good coffee. The United States is not familiar with great coffee. And for many years, it's only really on the East Coast and the West Coast that care very much about quality coffee. But obviously over time, that will change and people will want to bring that really great coffee experience home. And that means they'll be buying coffee machines and putting them in their homes. It's normal in Australia. It's normal in Europe. It's been around for, doing that's been around for half a century in Europe or more, 75 years or more in Europe. But in the United States, it's a relatively new concept. And Breville is leveraged to that particular theme. It's growing very, very well. It has high rates of return on equity, which suggests it's got a competitive advantage. We believe that that's embedded in its brand and the perceived quality of its products, and its share price is off considerably, given how disliked small caps are at the moment. So there's 2 examples that we really like in the small cap space. As I noted right at the beginning of the presentation, it's important to note we own these businesses, so please don't rush out and buy them without seeking personal professional advice. And that's all I've got time for. I do hope that you enjoyed the presentation. I look forward to your questions.
Thank you, Roger. I do have a couple questions for you.
Thank you.
First one is to summarize for our viewers, what are the top 3 reasons people should invest in a small cap fund right now?
Diversification, growth, and many small cap funds have underperformed. If that performance is due to undervaluation, then that is a compelling reason to be investing in small cap actively managed funds today. And if I can give you a fourth, the Future Fund, which has been very successful timing its investments in with active managers or in passive, has just switched to active small cap management.
Right. And when researching a small company to invest, what are the characteristics and competitive advantages of the small cap companies that you and your team are looking for?
Well, I think with small caps, one of the most important things, and I didn't talk about this in the presentation, but it adds to what I've already said, the management is really, really important. It's worth spending some time conducting due diligence on the people running the business and having a look at what their previous experiences have been. In many cases, CEOs and management teams of smaller companies have been with other small companies in the past. They've grown those businesses and on-sold them. And a track record of doing that is a great sign and something to look out for.
Yep, makes sense. Well, thank you, Roger. Great to see you. Take care.
It's a great pleasure to be with you, and thank you for having me as part of your conference.
Cheers. For those watching our live stream, this is the end of the first night of the Investment Markets Investor Webinar. Tomorrow, our event will be held at 11 o'clock in the morning and conclude at 2 o'clock in the afternoon, which is the only daytime event in our 3-day webinar. We'll have a packed agenda tomorrow, starting with the alternative ESG perspectives and global perspective with our guest speaker, Chief Economist from Beta Shares, David Bassanese. He will provide us an economic update, followed with a Q&A with me. If you register for this event, you will receive a link to watch the recording of tonight's presentations and Q&A later. If you have any follow-up questions, please email events@investmentmarkets.com.au. We look forward to seeing you tomorrow.